Okay, sir, coming to our financial instruments, the background of this is, see, even though this is viewed as a chapter for our study mat point of view, this is a mixture of three standards. Ind AS 32, whose title is Presentation of Financial Instruments. Ind AS 109, the Recognition and Measurement Principles, is the main accounting standard here. Ind AS 107, not at all important, disclosures relating to financial instruments. Now, broadly we are going to cover these two, sir, Ind AS 32 and Ind AS 109. Now, between these two, Ind AS 32 is a dry standard. It contains definitions and high core principles of equity and financial liability. But Ind AS 32 will lay down the entire base for accounting of Ind AS 109. Okay, so Ind AS 32, though it's a slightly dry concept, but still from a conceptual point of view and Ind AS 109 point of view, Ind AS 32 is important. Disclosures not much important, sir. As such, I have included in the book, but they are not very important from an examination point of view. Anyway, now coming to the term financial instrument, what it means is, first and foremost thing, financial instrument is a contract. Now, if there has to be a contract, at least how many parties are required? Two parties are required. Now, in these two parties, to one party, the contract, whatever these fellows have entered, a contract is a financial asset to one party, and to the opposite party, it is a financial liability, or it can be his own equity instrument. So a contract which is a financial asset for one party, and to the opposite party, either it is a financial liability or it is a equity instrument. Now, this entire contract is called as financial instrument. Now, when I say we have to learn accounting of financial instrument, means there is nothing called as accounting of financial instrument separately. You have to learn accounting of financial asset, you have to learn accounting of financial liability, you have to learn accounting of equity. So overall we call it as financial instruments ka accounting. Now, there is no accounting for financial instrument per se, we have accounting for financial asset, financial liability and equity instrument. Now, the person to whom this contract is becoming a financial asset, he is referred as a holder. Is referred as holder of financial asset, and the party, the opposite party to whom this contract is either becoming a financial liability or own equity instrument, he is referred as issuer. So broadly we are going to learn accounting in two parties books. One is holder books, one is issuer books. For a holder, the contract always is a financial asset. For a issuer, it can be financial liability or it can be equity. Sir, for this fellow only confusion is there. For him confusion is not there. Why? He has only one answer, financial asset. He will always say financial asset. But the issuer, whether he will call it as a financial liability or equity, that depends on so many stories there. So Ind AS 32, whatever is there, presentation of financial instruments, in this standard definitions are there, some accounting principles are there, but 90% of the stuff of Ind AS 32 is only revolving around whether for an issuer entity a contract is a financial liability or whether it is an equity instrument. Entire Ind AS 32 predominantly will revolve only about this concept, whether it is a financial liability or whether it is equity. Okay, sir, financial liability, so what? Nothing. If it is financial liability accounting you have to do. If you call it as equity accounting you have to do. And a financial liability accounting is not covered under Ind AS 32. For that you have to go to Ind AS 109. Sir, what if I call it as a financial asset? I am a holder. For you also accounting is covered under Ind AS 109. So accounting specifically is covered under another standard. Each particular standard gives you theoretical base, the definitions and whether it is a equity or financial liability for you. Broadly only this much. Now let's come. Sir, a definition of that fellow used of financial asset, financial liability in a term and also equity. Now they have to define what is financial asset, what is financial liability, what is equity. Now, a financial asset is any asset that is cash. He is outrightly telling that cash is a financial asset for you. That means you are having cash in hand, cash at bank, bank balances, all these are outrightly financial assets. Not only that, an equity instrument of another entity. That means you are X Limited, you invested in equity shares of Infosys Limited. So from your point of view, from X Limited point of view, this is an asset only, investment. And where did you invest? In the equity shares of another company. Another company ka equity share, if it is becoming an asset to you, that asset is a financial asset. So first is cash. Second one is equity shares of another company. If you are holding it, that is also a financial asset. Third one, contractual right to receive cash or another financial asset from another company. Now, first look, cash he told. Next he told equity share of another company. If it is your asset, that is a financial asset. Now he is telling contractual right to receive. Receive what? The first two. Either cash or any other financial asset. Who is any other financial asset? Equity instrument of another entity. That means, if you have a contractual right to receive cash from somebody, a contractual right is also a financial asset. If you have a right to receive shares from somebody, that contractual right to receive shares also is a financial asset. Example, I sold goods to you on credit. You owe me money. Do I have a right to receive money from you under a contract? Yes. Debtor is a financial asset. I gave loan to this sir. I have a right to receive money from them. Now in future, after 20 years, it doesn't matter. Do I have a contractual right to receive money? Yes. It's a financial asset. So debtor, contractual right to receive cash. Loan given, loans advanced, contractual right to receive cash. These are all financial assets. Next. Prepaid expenses. Can it be financial asset? Next month ka salary paid off now only. That's an asset, but not a financial asset. Why? I have a contractual right to receive services, not cash. So we should have a contractual right to receive cash. Then it is a financial asset. Any receivable is not a financial asset. Next. Tell me. Reliance Industries issued debentures, redeemable. They issue today, they are redeemable after 5 years. Every year they will pay me some coupon payment. I purchased that debenture. What do you think? Financial asset or no? By purchasing a financial asset called as, by purchasing an asset called as investment in debentures, what right I have? I have a right to demand coupon payments for the next 5 years, and at the end of 5th year I have to right to demand principal payment also. That means I have a contractual right to receive cash. If I have a contractual right to cash, that is a financial asset. Now what if I change the example and tell you that fellow issued debentures, next 5 years he'll pay interest. After 5 years, they won't pay me principal. In place of principal, they will convert that into 10 equity shares of Reliance Industries. That means I have a contractual right to receive cash for 5 years, interest. After that, I have a contractual right to receive equity shares of Reliance Industries. Tell me, equity shares of Reliance Industries is a financial asset or not? Yes, I have a right to receive a financial asset. A right to receive a financial asset is also a financial asset. Therefore, investment in redeemable debentures financial asset. Investment in convertible debentures also is a financial asset. Are you understanding, sir? Third. Coming to fourth one. Wait. Yeah. Contractual right to exchange financial assets or financial liabilities with another entity under conditions that are potentially favorable to the entity. What is the meaning of this is? To keep it extremely simple, let's think like this. Sir, you all understand what is a call option? You understand what is a call option? Call option, how many parties are there? Holder, writer. Holder will have right to buy. Writer will have obligation to sell. Now, let us say this fellow is holder of call. In his hand, one call option is there. E call option ka exercise price is 1000. This is, or else right, maturity date 30th April. Today he is standing on 31st March 2025. Already share ka market price is 1400 today. But he can't exercise the option today. He can exercise the option only after 1 month. But looking today, you tell me, sir, is the option looking good or bad from this holder point of view? Call option meaning right to buy. Market price today is how much? 1400. I can't exercise now. I can exercise only after 1 month. But looking at the rate of difference there, next 1 month, sir, 1400 will not become 900, no, sir. It will be around 1400 or it may rise also. So there is high chance of option getting exercised. So things are looking favorable or unfavorable? Favorable. or in fact he need not even hold till next 1 month. No, today also he can square up. You are a holder, that means you are a buyer of option. You can also sell the option today. If you sell the option today also, you will make a gain. That means a particular position is a favorable position to you. If you cancel this contract, if you sell off this option right now also, you will make money. Therefore, this is a financial asset. Favorable positions are financial asset. Now, if this fellow is a holder, another background scenario, there will be writer also. Tell me, sir, idhe position, same thing, is it favorable or unfavorable for the writer? If for the holder it is favorable, for writer also it's favorable. No, it can't be like that. No. So if it is favorable for the holder, it is obviously unfavorable for the writer. So for him this is unfavorable. For this fellow it becomes a financial liability. That means the way at which the market price is looking today, eventually writer has to pay money to the holder if they are going for a cash settlement. Writer is a loser, holder is the winner here. So the holder will call it as a financial asset, the writer will call it as a financial liability. So that is D part. Potentially favorable. Potential means future favorable looking, but it will be settled on a later date. Potential is about future. Next. Financial liability. A financial liability is any liability that is a contractual obligation to deliver cash or other financial asset to another entity. Now, come to C point above. What is C point above? A contractual right to receive cash, a contractual right to receive other financial asset. Here, contractual obligation to deliver cash is a financial liability. Not only that, contractual obligation to deliver any other financial asset also. That is also a financial liability. Example, I purchased goods, I did not pay the money. I took a credit period of 3 months. As on today, do I have an obligation to pay money? Yes. It's a contractual obligation, not any obligation. Every obligation will not become financial liability. Contract is must. So there is a contractual obligation to deliver cash. Definitely financial liability. Creditor is a financial liability. I took bank loan of 100 crores. I'll repay at once over a period, installment, or whatever it is. But do I have a contractual obligation to pay or not? So bank loan is a financial liability. I issued debentures, redeemable. Next 5 years, every year I have to pay a coupon of 14% interest. And at the end of 5th year, I have to redeem at par or premium, whatever it is. So for the next 5 years, I have an obligation to pay cash for coupons. At the end of 5th year, I have an obligation to pay principal amount cash also. Contractual obligation to deliver cash. Next. If you remember, while doing schedule 3, I told you one example of short sale. Short sale, what is happening? Stock lending scheme. I borrow share from somebody. I sold it out. Later, I will again buy and I will repay the share. Correct? What's the first entry we wrote there? I borrowed the share and I sold off. Bank account debit to one financial liability. Why did I call it as financial liability? Is by borrowing share from him and selling off in the market, now I have an obligation to buy that share in the market and deliver it to him. What obligation I have? I have an obligation to deliver a financial asset. Obligation to deliver a financial asset is also a financial liability. That is what that fellow writes there. See there? Contractual obligation to deliver cash, contractual obligation to deliver a financial asset. These two are financial liabilities. Next. D point you read above. What is D point? Potential favorable situations are financial assets. If potentially things are looking bad for you, then you may end up paying money to the opposite party. Same example. Holder ke favorable, writer it will be unfavorable. Holder is calling it as financial asset, writer will call it as a financial liability. That's next one. C point will come and talk after some time, sir. Because that's something called as F2F test. We'll talk about that later on. Next. So financial asset over financial liability over definition. Financial asset lesser cash is a financial asset. Equity instrument of another entity is a financial asset. Contractual right to receive cash, contractual right to receive any other financial asset is also a financial asset. If potentially favorable situations you are there, contracts are going to end favorably for you, that is also a financial asset. 4 points. Financial liabilities. First one, contractual obligation to deliver cash is a financial liability. Contractual obligation to deliver any other financial asset, financial liability. Potentially unfavorable situation, you end up paying money to somebody, also a financial liability. there is one more point which I postponed it. We will talk about that later on. Now coming to equity instrument. Equity instrument official definition is, sir, in a company, all the assets you sell, money will come. With that money, repay all the liabilities. After all the liabilities are over, last whatever is left, that money belongs to somebody, no? That somebody has got a paper in his hand. A paper is called as equity instrument. So equity instrument is that instrument which evidences a interest in the residual net assets after paying all the liabilities. All the assets you sold, all the liabilities you pay, whatever is left or whatever is left belongs to somebody. That somebody is called as equity instrument holder. In a general example, imagine a company under liquidation. If a company is under liquidation, after paying all the liabilities, who will eat that money? Equity shareholders. Why? How did he become equity shareholder? In his hand, what is there? Equity share is there. That equity share is an equity instrument. Equity instrument is equity in a word is a very broad word. In that, one classic example is equity share. It's not like equity share is the only equity item. There are multiple equity items. We'll come to that one by one. Now watch this. The ordinary plain equity share is an equity instrument. You tell me, sir, what is the characteristics of plain equity share? Can an equity shareholder demand a dividend? No. If the company pays, it will pay, but you can't demand dividend. Can equity shareholder surrender their share and demand payment? No. That means an equity shareholder cannot create a obligation on the company to pay certain dividend. He can't create an obligation on the company to repay the amount. That means from a company angle, if you see, company does not have any contractual obligation to deliver cash. If you have contractual obligation to deliver cash, it will become what? Financial liability. Equity instrument should not have a contractual obligation to deliver cash. The important point. Number 2. Moreover, by issue of equity shares, is the company promising any return? Will I say that buy my company share, I will ensure that you will get 25% return every year? Will I promise like that? No. That means equity instruments are the most risky instruments. They are the instruments where the company does not guarantee or underwrite any kind of return. If I promise anything to you, you are not an equity instrument holder. Because, sir, when I make a promise, your reward is limited only to the extent of that promise. Suppose I told you, you gave me 1 lakh rupees. I told you that I will give you 10%. Everybody is giving 10%, sir. Okay, sir. I will give you 15%. Give me money. You gave me money. If 1 lakh I earned 30%. But I will pay you only 15%. How can I call you owner? Owner is somebody who is taking unlimited risk and unlimited return exposure he should have. Somebody who is happy with a meager return, fixed returns, that fellow cannot be called as owner. That's why we don't call it as equity. Equity ka fundamental characteristic is he cannot create an obligation on the company for fixed returns. He can't create an obligation on the company for repayment. He is somebody who is taking unlimited risk and unlimited return ka opportunity. These 3 are the characteristics of an equity instrument. Now I will tell you one example. You tell me whether that is an equity instrument or not. A company issued irredeemable preference shares with a discretionary dividend. I issued irredeemable preference. Sir, you can't issue, sir. Shut up, sir. That is example. India you can't issue. Foreign standard, no. So, company issued irredeemable preference share. Irredeemable means principal amount I will not repay. Dividend 12% I told, but that's not mandatory. Discretionary. I may pay, but do I have an obligation to pay? Do I have an obligation to repay? No, that means I don't have any obligation. If I don't have any obligation, it can't be called as a financial liability. So automatically it will become a equity instrument. Clear? Another example. I issued compulsory convertible debentures. Compulsory convertible debentures. Interest discretionary. Next 5 years interest. If I want, I will pay, otherwise I will not pay. Name interest. Nature is dividend only. I may pay, may not pay. That's my wish. And the debentures are not repayable. They are convertible into 1 lakh shares. So do I have an obligation to repay debentures? No. I have obligation to issue shares. Is shares my financial asset? Other company ka share is a financial asset for me. My own company ka share, how is it a financial asset for me? That's an equity. Are you understanding, sir? So I issued debenture today, named debenture, but that's not a redeemable debenture. That is a convertible debenture. Interest discretionary. I don't have an obligation to pay interest. I may pay, but I don't have an obligation to pay. Repayment, not there. Sir, then how will you close it? I will convert that into 1 lakh equity shares. Equity shares, sir, you have an obligation to issue equity shares, correct? Obligation to issue equity shares, it's true, but tell me, my own company ke equity shares, the financial asset. That means I don't have an obligation to issue financial asset, no. If I don't have a contractual obligation to issue financial asset, it can't be a financial liability. Therefore, it becomes a equity instrument. Clear? Examples and all I have given here, sir. You can go through it later on. We can again talk. We'll see accounting of all that. Next. Next one, sir. Sir, in the book I have written a little bit about derivatives because some students innocently come off to FR without covering SFM. So for those people, what is derivative? What are the various types of derivatives? Forward, future, option, how it will work. A little basics I wrote there, but apparently it looks like you are not that innocent. Anyway, we'll talk about derivatives more when we do accounting of derivatives, okay? Later on. These are just for small kids, not you. Okay. Sir, derivative general definition is, it's a contract whose gain or loss is dependent on the value of the underlying. So, in a very, very crude sense, if I should put it, derivative is a betting contract, sir. There are two parties. Suppose, sir, you and me both are betting on India-England test match. She says India will win. I also say India will win. What bet can we play? So I should say England win will. Then there is a bet, right? So both the parties cannot win. One party will win, another party will lose. Now whether which fellow will win, which fellow will lose depends on the outcome of the match. So there is something else which is deciding our gain or loss. These contracts are called as derivative instruments. Now, generally, sir, who can be that underlying? That can be anything, whatever you and me decide. Today it will rain or not. That's one betting. So who is underlying outcome there? Rain. If it comes, one of us will win. Otherwise, another fellow will win. So, but generally speaking, most of the examples, they take equity shares as an underlying asset, interest rate as an underlying asset, index, Nifty Sensex as underlying assets, interest rates are taken as underlying assets, commodities are taken as underlying assets. So, based on various underlying assets, people start betting transaction. Now, for doing a bet, I need not invest anything, no, free only, no, sir. So, most of the betting transaction, initial investment is zero. Whether you will win or not, only time will tell. And your gain or loss is dependent on the price of something else. These three are the characteristics of derivatives. You can see the three conditions. Sir, derivative is a contract whose value depends on the value of the underlying. This is the definition what you study in your AFM. But in FR India's 32.109, this is the definition. These contracts require zero or a very small initial investment. First one. Second one, the value of the contract is derived from the value of the underlying. Number 3, such contracts are to be settled on a future date. Three are the essential characteristics of a derivative instrument. Now, I'm sure you must be knowing what is forward, future and option. I'm not going much into that, but whenever it is there at the time we'll talk about that. Now, look at this point. In this entire chapter, sir, when you have a derivative contract in your hand, a derivative can have four fates. Four fates it can have, any one of these four. A derivative can be classified as a financial asset. A derivative may be classified as a financial liability. Derivative may be classified as an own equity instrument, or derivative can be scoped out of the standard. Scoped out means you are a derivative only, but your accounting is not covered under our standard. Get out. Sir, then where is it covered? Nowhere. How to do? We will see that. But overall, if somebody asks you, what is the accounting of derivative? You should not jump to an answer like that. You should first ask, how is the derivative classified? What is the nature of the derivative? If it is financial asset or financial liability, one type of accounting is there. If it is equity, one type of accounting is there. You are scoped out. As accounting is not there in the standard. It's like that. Now, one example we will see here. Come here. Theoretically important, sir. On this, practical questions do not exist. Only one big question is there, but that's a theoretical question. Contracts entered on non-financial assets to be executed in future. Now we'll start this with an example. Watch this out. Suppose, guys, A Limited entered into a contract to buy 1 kg of copper at 3 months from B Limited at rupees 600 per kg. Now, a contract is going to be settled at what time? 3 months time, not now. It will take at least 3 months time to settle the contract. Now, you think only from A Limited's point of view. You are A Limited here. What is the rate at which you agreed to buy? 1 kg 600 rupees. Okay, now, at 3 months time, A Limited, B Limited. A Limited will buy the copper 1 kg and he has to pay an amount of 600 rupees. This is how the contract will be closed by way of gross settlement, also called as physical delivery made. Okay, now, first and foremost thing, this particular lines if you study, do you feel that it's a derivative or not? Is it a derivative or not? Is there any initial investment? Is there any initial investment? No. Is the price locked? Is the price locked? When price is locked, and transaction is going to be settled on a future date, definitely one party will suffer a loss. One party will definitely make a gain. How will I know? To wait. Sir, after 3 months, imagine, copper ka price is 700. What is the meaning of this? He is buying copper worth 700 but paying an amount of 600. So he is gaining by how much? He is losing by how much? 100. If it is 500 rupees, he is losing by 100, he will be gaining by 100. Or you understand, sir, depending on the price of the copper, one party will gain, another party will lose. Who will gain, who will lose? When will they know? In future they will know. Time will tell. Today investment is zero. This is a classic example of forward contract. Forward contract, sir, price is identified today. Parties will take either a buy position or a sell position. Who will win, who will lose, the time will tell. Are you understand, sir? This is a forward contract. Pakka 100% derivative. Now, how to do accounting of this derivative is not covered here. That's covered in a standard called as India's 109. Next standard. This standard of what is covered is, so the kind of contract, is it within the scope of our financial instruments or not? Only that much is our limited discussion. Now, sir, if I remove the word copper here, okay, and I put Infosys share, now I will not ask you whether this is covered under the standard or not. Why I will not ask you is, what did you agree to buy? Infosys share, and Infosys share is a financial asset. So you are making a contract to buy a financial asset. So obviously it is covered under the standard. I will not get any doubt there. But this particular example is based on what? Copper. And who is copper? Copper is a non-financial asset. So two parties made a contract on a non-financial asset. As an underlying asset, not a financial asset. When it is not a financial asset, should I really study this under financial instruments or not? That is the doubt I am getting. If the underlying asset was equity share of any company, why will I get a doubt? But if you put gold, silver, copper, any metals or any soya bean, onion like this, these are not financial assets. So you are playing a betting game on a non-financial asset. Now I get a doubt. Sir, some fellow entered into a contract to buy onion, sir. How is it financial instrument? I am a power generating company. I entered into a contract to buy coal. How is it a financial instrument? A derivative. But how is it financial instrument? The underlying asset is not financial instrument. No. So that's where we get a doubt. The standard asks you one thing. Case 1. A Limited is engaged in copper business and will close the contract by way of physical delivery to meet his own usage purchase requirement. That means we have to see what is the intention of the party or objective of the party when he is entering into the contract. A Limited, why did you enter into this contract? A Limited says, are you mad or what? Copper is my raw material. After 3 months, market price may increase. Safe side, I locked the price now. Okay. Now, after 3 months, market price may be 700, maybe 500. Whether it is 700 or 500, he will anyway buy the copper at what rate now? 600. His goal is not just gain or loss. He wants copper for his own business purposes. So you tell me, does he have a speculative intent or no? He does not have a speculative intent. And contract is settled in net cash settlement, gain or loss of physical delivery. I am not here for doing a betting transaction. I want copper availability after 3 months. So I entered into a contract. So ultimately contract will be closed by delivery of copper. Speculative intent is not there. E kind of transactions are scoped out. The standard says we do not cover your accounting. It is a contract entered today for a future purchase. Sir, what accounting will I do today? Nothing. Sir, then when will I do accounting? When will you buy copper? After 3 months. At the time, right. Purchase account debit to bank directly. Don't do any accounting for the next 3 months. Scoped out. Derivatives are scoped out. No accounting is covered. Case 2. A Limited will close contract by way of net cash settlement. What is the meaning of net cash settlement? Net cash settlement ka meaning is, if at 3 months market price of copper is rupees 750 per kg, A Limited agreed to buy at what rate? I locked the price at 600. Market price is 750. I am in a gaining position or losing position? Gaining position. 750 ka item I am able to buy only at 600. I am gaining or not? Gaining. Gaining by how much? 150 rupees. There is no copper ka delivery and all. Copper is used for betting purposes. I told copper ka price will rise beyond 600. That fellow told that much scene is not there. Bet up, bet. Ultimately price went to 750. I won, he lost. He will pay me 150. Okay, now here how the contract will be closed is gain to A Limited will be market price is 750. I agreed to buy at 600. 150 rupees is the gain. And therefore A Limited will directly receive an amount of 150 from B Limited. The contract is settled in net cash settlement. Losing party will pay money to the gaining party. Tell me, sir, who is the underlying asset here? Copper A. But settlement is happening in cash. That means, is this fellow interested in copper, cash? He is interested in cash. And cash is a financial asset or not? Yes. Therefore, this contract is covered under this standard. So, this is covered. Understand the logic behind why some things are scoped out, some are not scoped out. First one is scoped out because you are not interested in cash, you are interested in copper. Copper being a non-financial asset, it has got no connection with your financial instrument standard. Out. Here, betting is happening on copper, but settlement will not happen in copper terms. Settlement will happen in cash terms. So, cash is a financial asset. No, so you are covered under the standard. Okay, sir, covered. No, now tell me accounting. Not yet. That is in India's 109. We will cover it. Here only scope. Case 3. A cheating case. A Limited not engaged in business of copper. They have no connection with copper business. Okay, but A Limited will only take physical delivery of copper. Now you tell me, sir, how will you handle this case? First case, he was in copper business. He will take physical delivery. We told scoped out. Second example, he will outrightly do net cash settlement. Scoped in. Third one, he is not at all engaged in copper business, but still he will take only physical delivery. What about this? He will take physical delivery only. Then what will he do after taking physical delivery? He will sit on that copper. He will sell it off. That means what, sir? I pay 600 to you. I take copper from you, whose worth is 750. Spotlight will sell it for 750. That means effectively what happened? 600 I paid to you. I will receive an amount of 750. Net my gain is how much? 150. That means it is in substance equal to doing a net cash settlement. Meaning at 3 months, A Limited buys copper at the rate of rupees 600 and sells at market price of, let's say, 750. Therefore, gain is equal to rupees 150 in cash. This is in substance net cash settlement. Therefore, scoped in or scoped out? Scoped in. Scoped in. This is scoped in the standard. It's like somebody wants to escape the standard, sir. That fellow, what he will do, he will put a physical delivery clause only. Outside he will sell. That is as good as net cash settlement. So you are covered under the standard. You can't cheat the standard. At least not here. Case number 4. If you can't cheat the standard, how will you make money, sir? You should know how to cheat. But here, not possible. Case 4. A Limited has the option to close contract by way of physical delivery or by way of net cash settlement. What will be your answer here? Contractual, both the choices are there. My wish. If I want physical delivery, they'll give me physical delivery. If I want gain or loss, they'll directly give me gain in rupees. Or if I lose, I have to pay in rupees. Yeah. Scoped in, scoped out. How do you know that? See, there is a cash settlement option. That much is there. It's looking like it is covered under the standard. But here, his objective and intention also is important. Suppose, sir, I am engaged in copper business. I really need copper. And my past history, I have never done cash settlements. I always took it on physical delivery basis. Sir, when you always took it on physical delivery basis, why the hell did you keep a cash settlement option here? Listen guys, cash settlement option sometimes may be kept for safety reason. For example, after 3 months I want copper, sir. Some natural calamity happened. That opposite fellow is unable to deliver copper to me. I can't stop my production, no sir. I have to buy the copper outside. So, but outside market the prices have increased. So what I will do, I will choose net cash settlement. If I choose net cash settlement, what will happen? I will get the gain portion from him. Outside I will buy at a higher price. Overall, more or less it will be like the same contracted price I will be buying up. So for safety reason also I might have kept a net cash settlement. I kept net cash settlement, not that I am interested in doing that. That's why the standard says, when you have a choice like this, examine your settlement mode in your previous transactions and your current intention. If you intend to take only physical delivery to meet your own usage requirement purposes, then you are scoped out. Otherwise, you are covered. Scoped out. So, in case la answer is, it depends on your past history of settlement in similar contract and your current intention. That's it. So, this entire thing I have summarized here. Contract settled by way of physical delivery, exempted from India's 109. Contract settled only by way of net cash settlement of gain or loss, or contract entered for the purpose of delivery and selling the commodity in the market immediately for a speculative gain, also a deemed net settlement case only. Here also you are covered under the standard. Last one, option exists to obtain physical delivery or net cash settlement. In this case, you check the current intention and history of past settlements in similar contracts. If it can be established that objective is to obtain physical delivery, though cash settlement was done in insignificant cases. In the past 100 times if I entered into this contract, 95 times I have taken physical delivery. 5 exceptional emergency situations I had to take net cash settlement. That's okay. Broadly, predominantly your objective is to take physical delivery, therefore you are also exempt. Here, it's not about your speculative intent. That's for easy understanding we tell. Actual reason is not that. Actual reason is, am I going to take copper or am I going to take or pay cash? Copper, non-financial asset, scoped out. Cash, financial asset, covered. That is the main part. But instead of telling that, speculative intention is easy to explain. From that angle we explain, but as such, the logic is about financial, non-financial part. Next. So, this is whatever you have seen is one example of a derivative which is scoped out of the standard. Then there are derivatives which can be classified as financial asset, financial liability, equity instrument. Now, these two also we have covered. You know where? This fellow. Call option, derivative. One fellow holder, another fellow writer. Compare the exercise price with today's market price. You will understand whether the call option is looking favorable for you or unfavorable for you. If it is looking favorable for the holder, it is a financial asset. So it means it is unfavorable for the writer. For him it is a financial liability. That means a derivative getting classified as financial asset you have seen, derivative classified as financial liability you have seen. Just now also you have seen derivative scoped out of the standard. One more is there. Who is that? Derivative getting classified as a equity instrument. That also you will see in the following examples next. Next. Sir, a small chart whatever is there now. Contracts to be settled in own equity instruments. That means our company entered into a contract with our opposite party. A contract end result is our company will issue our own shares to the other party, or that other party will the other party will give to us our own shares. Once again I will explain. Sir, I and this sir entered into a contract. After 3 years, I have to give my shares to him. First example. Example number 2. I entered into a contract with this sir where he will deliver my company ka shares to me only after 1 year. In both the cases, what is common? Settlement is happening in our own company ka equity shares. In one case, we had to deliver. In another case, he will deliver my own company ka shares to me only. So in one case, we will give our shares to them. Other case, they will give our shares to us. In two cases of commonality is ultimately contracts are settled in our own equity instruments. Am I clear till here? Now, in this importantly, we have to cover fixed to fixed. Most important conceptual. And then compound financial instrument ka meaning we will study here, but accounting again in 109 it is there. Yeah, these are all simple stuff, so there is nothing much in this. Let's start with fixed to fixed. Okay, now the first concept we are studying, major concept we are studying in financial instruments is this only, sir, fixed to fixed. What this concept says is, where our entity issues fixed number of own equity shares for fixed amount or value of consideration, that contract is classified as equity instrument. So there is a contract our entity has entered, sir. Under this contract, our entity has to issue fixed number of shares for fixed amount or fixed value of consideration. Two things should be fixed. Number of shares to be issued should be fixed. The amount or value of the consideration which the company is going to receive, that also should be fixed. If these two things are fixed, a contract under which this is happening, a contract is classified as a equity instrument. So two things should be fixed. Now, what are the two things? One is number of shares. Next one is value of consideration. These two things. Now, if this is fixed, this is also fixed. We are going and giving a classification of equity. If this is variable, but this is fixed, or this is fixed, the second one is variable, or both are variable. In last three cases, sir, are contracts, even though they are settled in our company ka own equity shares, still they are classified as financial liability. So whether a particular contract is an equity or financial liability depends on whether did you pass the F2F test or not. F2F test means two things should be fixed. Number of shares to be issued should be fixed. The value of consideration what the company is going to receive also should be fixed. If both are fixed, then the contract is classified as a equity instrument. Okay, now if any one of these are variable, then the entire contract will be classified as a financial liability. Okay, now let's see some examples, sir. We'll get a more understanding of this. Now, sir, a company issued debentures today. They raised an amount of 10 lakhs. Okay, these debentures are convertible into 10,000 equity shares at year 3 ending. At the end of year 3, a 10 lakh rupees ka debenture is convertible into 10,000 equity shares. Now, from company's point of view, analyze this. Sir, who will classify equity liability? Issuer or holder? Who will classify equity liability? Issuer. Who is issuer here? A Limited. Company point of view, decision. Not from holder point of view. Holder it doesn't matter, sir. If it is equity also, if it is financial liability also, for the holder it is always a financial asset. We are talking classification means we are talking from issuer point of view, not from holder point of view. Holder does not have much of choice there. Okay. So, A Limited point of view we are discussing. So, ask yourself. Number of shares to be issued. How many number of shares we have to issue? 10,000. So, here it is fixed. 1F is satisfied. This time value of consideration. Value of consideration is whatever you have issued for, which is 10 lakh rupees. This is also fixed. So, FTF test is passed. If FTF test is passed, a contract is classified as a equity instrument. Therefore, a debenture contract, whatever is there, is classified as a equity instrument. That's the summary of this. Now, big deals are, anyway you are going to issue equity shares, no? Anyway it is classified as equity. No, sir. Not like that. It will be classified as equity only when F2F test is passed. Moreover, you must understand one thing. In your balance sheet, debentures is forever. Ultimately, it will get converted into equity shares. Today it is debenture. For how many years? 3 years. After that, it will become equity share capital. Correct? Once it becomes equity share capital, anyway equity only. I am not talking about after 3 years what will happen. After 3 years, once you issue real equity shares, stupid ordinary equity shares are anyway equity only. I am not asking after 3 years onwards what will you call it. Next 3 years what you will call it. Name debenture, sole equity. Name lo debt is there, heart is equity. Meaning or implication of this F2F test is like this. Watch this, guys. Suppose at 3 years time, market price of the share and value of 10,000 shares. Tell me, sir, market price of the share is 130. 10,000 shares ka value is how much? Multiply, sir. 10,000 into 130, how much? 130 lakhs. 13 lakhs. From investor's point of view, think. Investor gave to the company how much money? 10 lakhs. How much is he getting now? 13 lakhs. Is he happy or sad? He is reasonably happy only. He invested 10. He is getting shares whose worth is 13 lakhs. So this fellow is reasonably happy. Now, 180. 18 lakhs. Very happy. Now, 10. What is the meaning of this is, when share price is increasing, they are happy. When share price is decreasing, they are sad. Normally when share price increases, who will be happy? Normally, equity shareholder. That fellow will dance. This fellow is also dancing. He is equity shareholder? No. He is a debenture holder. But inside heart is equity. Substance over form. Legally, your name is debenture, but your heart is equity. Like how equity shareholder wants share price to increase, this fellow also wants share price to increase. If share price falls down, equity shareholder will cry, this fellow also will cry, and company is not going to compensate. Because you agreed for fixed number of shares, you took that risk. You took a risk which is equivalent to the risk of a equity shareholder. That's why I am giving you the status of your named debenture, but you won't sit under non-current liabilities and all. You'll sit under top category. Equity, non-current liability, current liability. This fellow will sit under equity heading, not under current liabilities, non-current liabilities. You getting it, sir? That is the implication of this. Now, the first example. Let's take another one. Company issued debentures. Again, same. Raised 10 lakh rupees. Will be converted at year 3 into equity shares worth rupees 16 lakhs. I made a promise that after 3 years I'll not pay you cash. I'll give you what? Shares only. But how much shares? Shares whose worth is 16 lakh rupees. Now, as on today, from company's point of view, think. What is the value of consideration received? How much did you receive? 10 lakhs. So this is fixed only. Now if I ask you, number of shares to be issued, 16 lakh worth shares I have to issue. So 16 lakhs divided by market price of the share. When market price of the share at the end of 3rd year. If market price is less, I will issue more number of shares. Market price is high, I will issue less number of shares. That means number of shares to be issued is fixed or not fixed? Not fixed, it's variable. So this is variable. Now that this is variable, your F2F test is failed. Therefore, a debenture cannot be called as an equity instrument. A debenture will become financial liability. Debenture will be called as a financial liability. Are you understanding, sir? Now, implication. Implication is more important. Watch this. Now, at year 3, market price of the share. Number of shares to be issued. How many shares I have to issue? 16 lakhs divided by market price. Now, first scenario, sir. Market price is, let's say, 400. How many shares I have to issue? 16 lakhs divided by 400, which is equal to how many shares? 4,000 shares. Market price is 100. 16 lakhs divided by 100. How much? 16,000 shares I have to issue. Market price is 10. I have to issue 1,60,000 shares. Market price is 1 rupee. I have to issue 16 lakh shares. Now, how many shares I have to issue, I do not know. But no matter how many shares you issue, this fellow's face of feeling will not change. Why? Sir, company share price dropped to 1 rupee. He'll cry, no. He will anyway get shares worth 16 lakhs. Share price increased to 400. He'll feel happier. No. He'll still get shares worth only 16 lakhs. So from this fellow's point of view, he invested 10 lakhs, he'll get a return worth 16 lakhs. That means the rate of return he is earning, fixed or not. If somebody's return is fixed, that means company is fixing return for him. Somebody who accepts a fixed rate of return, how can he become a owner of the company? Forget legality. In form point of view, owner is somebody who eats last. Whatever is left should belong to him. But this fellow will take only 16 lakhs. Not a rupee more, not a rupee less. So his returns are fixed. Once an instrument return is fixed, it cannot be called as a equity instrument. So that's why they put this F2F test. F2F test passing ka meaning is risk and rewards are assumed by the other party. F2F test failed means risk and rewards are not assumed by the other party. If the other party is not assuming risk and rewards, why will I call you as a owner? You are happy with a fixed return, no, you are outsider. That's why they call it as financial liability. Are you understanding the logic behind it, sir? So this is the background of F2F test. Now, watch this example. Now, what standard says is, okay, let me put an example. Suppose, sir, I have to pay her 2,000 rupees. In my pocket, 100 rupee notes are there. How many notes I have to give her? 20. I have 500 rupee notes. 4. I have 2,000 rupees note. 1, I have 10 rupee note. 200. That means, irrespective of the number of notes I am giving, the worth I am paying is same only, no? Correct? What the standard says is, you are issuing shares as if it is a currency. And how many currency notes you have to give depends on the value of the currency note. So you are using shares like money. Even though you are issuing shares, it is as good as you are paying fixed amount of cash to him. Giving variable number of shares is equivalent to paying fixed amount of cash. Obligation to issue variable number of shares is obligation to pay cash. Obligation to pay cash is a financial liability. That's how the standard links it. So financial liability ka definition ki F to F test failure case ki link is there. Are you understanding, sir? Now, if I should show you one small point which I omitted earlier, come here. Financial liability is any liability that is, read C point, a contract to issue variable number of shares or fixed number of shares for a variable consideration. What is that? FTF test ka failure will become a financial liability. Are you understanding, sir? Definitions, if you first want to read completely and then go into the standard, it won't happen. You have to first walk, then automatically clarity comes. Okay, one last example, sir, then we'll move further from FTF test. Okay, answer this case. Okay. Sir, I am A Limited. You will think only for A Limited, sir. This fellow is a reporting entity. Okay. A Limited. At a distance, there is one B Limited company. These four fellows hold 100% shares in B Limited. They are shareholders of B Limited. Now, A Limited entered into a contract with their shareholders. What contract? At 6 months' time, they will give us all 100% shares. Some number, let's say 10,000 shares. At 10,000 shares in B Limited, they will give us. And in return, at 6 months, we will give them 13,000 shares in our company, issued by A Limited. A contract is entered today but will be executed after 6 months. As on today, A Limited, how will they classify this contract? Equity or financial liability? One is consideration, you have to check. Next, you have to check the number of shares to be issued. You have to evaluate this from A Limited's point of view, sir. Okay, tell me. Number of shares to be issued is how much? This is fixed. What is consideration? Consideration is what here? Why am I issuing 13,000 shares? Simply, no. We will receive 10,000 shares in B Limited. So consideration is 10,000 shares in B Limited. At 6 months' time, we will receive this. You tell me, is that fixed or variable? Is it fixed or variable? Good. This is variable. How is it variable? Sir, after 6 months, what is the worth of each share in B Limited? How will I know today? It can be high also, it can be low also. Sir, what is fixed there? Trap, number is fixed. Number should not be fixed. Consideration ki value should be fixed. Shares ki number should be fixed. Point very important. Look at this. Normally, F2F is not something should be fixed. Shares ki number, consideration ki value. Here, shares ki fixed number, consideration also number fixed. That is irrelevant for me. Consideration also value should be fixed. So here consideration is a variable consideration. Gone. It is a financial liability. Are you understanding, sir? F2F test clearly. One last example. I told this one last. I lied. Okay. Now, X Limited writes a call option on its own 1,000 equity shares towards A Limited at an exercise price of 600 rupees. Maturity 3 months. Premium collected today rupees 50 per share. Yeah. You will think from X Limited's point of view. Sir, call option holder will have call option holder will have right to buy. So call option writer will have obligation to sell. Who is writer here? X Limited. Who is underlying asset? Our own shares. That means I have an obligation to sell my own share. Selling my own share is what, sir? Issuing share. Instead of saying issuing shares, I am doing overaction like I am selling my own share to you. That's as good as issuing share only. Okay. Now tell me, sir, from X Limited point of view, number of shares to be issued, is it fixed or not? How many shares? 1000 shares. Value of consideration, how much will I get? Rupees 600 per share. That means this is fixed. This is also fixed. F2F test is passed. Therefore, a call option, whatever X Limited has written, a call option is an equity instrument. F2F test passed. There you see one example of a derivative getting classified as a equity instrument. Copper example derivative, scoped out. We have seen that. Call option, same call option, sir. If it is not on own shares, if it is on Infosys company share, then X Limited and A Limited are playing betting game on Infosys share. One fellow will have a favorable position, one fellow definitely will have a unfavorable position. Favorable position ki financial asset, unfavorable position financial liability. So derivative getting classified as financial asset, financial liability, scoped out. Now you see in this example getting classified as an equity instrument. Derivative all four phases you have seen. Understood? Now come here. In the first scenario, sir, first example, where F2F test was passed, debentures case. Sir, after 3 years from my balance sheet, the debenture will be removed. A place to who will come? Second case, where F2F test is failed, E case law also, after 3 years, a debenture will be eliminated. A place to who will come? Here, after 6 months, when I issue these shares, in my balance sheet, what will come? Share capital. Here also, if this call option gets exercised in future, ultimately in my balance sheet, what will be there? Once a share is issued, as anyway equity item. I am not talking about what will happen after the issue of share. I am talking as on today, a contract is what? Sir, what nonsense? Why do you want to know that? Why do I want to know that? Come here. I entered into this contract, you paid me 50. I received 50. Now, if 50 ka treatment depends on whether this contract is an equity or a liability. If you tell me financial liability, I have one type of accounting weighting. If you tell me it is equity, there is altogether a different type of accounting weighting. So your accounting is dependent on your classification. After 3 years, stupid, everything will become equity shares only. After 3 years, who is asking? I am asking next 3 years of what accounting I should do. That is dependent on today's classification. That's how India's 32 assumes lot of importance before you do India's 109. Are you understanding, sir? Contract nature is important. Without knowing the nature, how will I account it? Okay, so that's the background of F2F test. Now, next concept is, I understood. Sir. Compound financial instrument. It's important, sir. Compound financial instrument. Now, these are instruments where CFI, instruments where which has the nature of equity, which also has the nature of financial liability. Equity ka nature is there, financial liability ka nature is there. Both are there in a single instrument. This kind of instruments are called as compound financial instruments. Now, the accounting of CFI is extremely important from an examination angle. That again is covered in India's 109. Now, we are just introducing to what is the meaning of CFI. That's it. Okay, now, debentures redeemable at 5 years, but interest is discretionary. If you observe the nature of this instrument, after 5 years definitely have to repay. So I have a contractual obligation to deliver cash. So principal portion we have a obligation to pay. Therefore this is a financial liability. And as regarding the every year interest, just like equity shares ka dividend, this is also discretionary. So we don't have a obligation to pay. Since you do not have an obligation to pay, E portion is looking like what? Equity. Overall, we call this as a compound financial instrument. That is one example of this. Now, I'll tell you another example. You will explain that. Irredeemable preference shares with mandatory dividend. Irredeemable preference share with mandatory dividend. Yeah, principal is not repayable at all. Therefore, that is sounding like what? Equity. Dividend, name a dividend, but every year compulsorily I have to pay. Contractual obligation to deliver cash. Therefore, it is a financial liability. So, I have a equity also, financial liability also in the same instrument. Overall, it is called as a compound financial instrument. Clear? Two examples. What if it is a irredeemable preference share with discretionary dividend? That is pure equity instrument. That's not a CFI. That is not a CFI. Why? There is no obligation to pay cash anywhere, nowhere. Okay. Now, last example. This one you have to think a little bit. Sir, this is redeemable, or else wait to write. Here it is there. My hands also I should say. Redeemable or convertible debentures with mandatory interest. No, half issue is solved there only. Interest is mandatory. Interest portion, definitely there is a financial liability. Now what is pending is either it will be converted. Of course, when I say converted into fixed number of shares only, or redeemable at the option of the holder. That is one case. At the option of the issuer entity, another case. Case 1, case 2. In both the cases, interest is mandatory. But in case 1, whether he wants cash, he wants shares, the holder will decide. Depending on what you ask, I have to comply. What is the meaning of option with the holder? If the holder at the end of 5 years, if he asks cash, we have to pay cash. If he asks shares, we have to give shares. Tell me, sir, how will you classify? Equity or financial liability? Why financial liability? Simple. Sir, I do not know what he will do after 5 years. But if he asks cash, can I say no? No, I can't say. I have to pay. Whether I will pay, he will ask, all that is different. Do I have an obligation to pay? Contractual. Yes. Therefore, it becomes a financial liability. So, here you have to remember that the principal amount is a financial liability. What is irrelevant is, sir, I believe that they will take only shares. That is irrelevant. You are not supposed to estimate what the other fellow is likely to do. If he asks cash, you can't say no, sir. That is a contractual obligation to pay cash. Definitely the principal amount is treated as a financial liability. Come to the other case. Option is with the issuer entity. What is the meaning of this? Whether I will pay cash, where I will issue equity shares, that is my wish. Suppose you are all the investors. After 5 years you came to me, sir, we want cash. I told, get lost, I will give shares only. Can you do anything with that? No. Can you create an obligation on me to pay cash to you? No. So company does not have a obligation, contractual obligation to deliver cash. There is no financial liability. Sir, company badly wants to pay shares only, sorry. Cash only, sir. They don't want to issue equity shares. They don't want to dilute their voting power and all. 100%. Pakka cash only they will pay. What will I do? No. Intention to pay cash. Obligation to pay cash. Same or different? For a fact, I know that I will pay cash only. But still, is that called as obligation to pay cash? Or expectation to pay cash? Expectation and obligation not one and the same. Obligation means you should not be in a position to say no if somebody asks cash. If I am only saying yes, that does not mean that I have an obligation. Okay, so when you do have an obligation, then financial liability. Voluntarily, if you are paying, that's not called as obligation. Okay, so irrespective of your intention is irrelevant here. Contractual obligation, do you have an obligation or no? I don't have. Therefore, the principal amount is classified as a equity. Till here, any doubt? I have a doubt. You told mandatory interest. Therefore, E portion is ఈ సెకండ్ సినారియోలో సార్ ఇంట్రెస్ట్ ఫినాన్షియల్ లయబిలిటీ, ప్రిన్సిపల్ का రీపేమెంట్ ఈజ్ ఈక్విటీ, ఇంట్రెస్ట్ का రీపేమెంట్ ఈజ్ ఫినాన్షియల్ లయబిలిటీ. సో ఓవరాల్ గా దిస్ ఈజ్ ఏ కాంపౌండ్ ఫైనాన్షియల్ ఇన్స్ట్రుమెంట్. వెరీ హ్యాపీ. కమ్ హియర్. ఇంట్రెస్ట్ మ్యాండేటరీ ఫినాన్షియల్ లయబిలిటీ, ప్రిన్సిపల్ మ్యాండేటరీ ఆర్ principal is also a financial liability. Overall it should be. But what are we studying? Compound financial instrument. Now you observe closely here. Always things are not so simple as they appear. Interest ka obligation is there, financial liability. I do not know whether that fellow will ask cash or shares. I do not know. But if he asks cash, we have an obligation to pay cash. Therefore, principal also is a financial liability. But overall, it is a compound financial instrument. It won't be a overall financial liability. It is still a compound financial instrument. Now, how is that? E point. You have to listen, sir. It's important for us because this has got something to do with the accounting of CFI later on. Okay, watch this. Now, guys, Reliance Industries is there. This fellow issues redeemable debentures at par. My question is, if he is this fellow is issuing debentures, this fellow is buying, no sir, this fellow is the investor. Now, they are issuing at par. How much interest rate they are offering is, let's say, the coupon rate is equal to 14%. That means, on every 100 rupees value you give me, I will pay you 14 rupees interest. Who is committing that? RIL is committing. Investor, why is he buying this? Is in his mind, no sir, he is thinking like this. A Reliance company is a risky company. Of course, government ka friend only, but not government, no. So, risk is there. Business ka risk will be there, no sir. If tomorrow RIL is caught under some fraud, do you think BJP government will go and say our friends only? No, no sir. Let them sing, let them die. I don't care. I don't know who you are. You simply took a selfie on that. So, this fellow mindless, some RR is there. RR is required return. 14%. He calculates all the risk. He reads the credit rating of RIL. Okay, for a company risk, I want a return of 14%. Surprise, coupon rate is also 14%. Feelings matched. So this fellow bought the bond. Case 1. Case 2. Issues convertible debentures at par. Coupon rate 12.5%. This fellow, sir, purchased this bond also. Now, if you observe closely, in his mind, how much return is there? But his second bond is offering a coupon of only 12.5. But that bond is compulsory convertible into equity shares. They won't pay principal amount there, compulsory convertible into equity shares. You know, whatever it is, on his investment he wants how much return? 14. But the bond is giving a coupon of 12.5. Ideally he should not buy the bond. Bugger bought. Why? Why? What he's feeling is, there is no option, compulsory convertible bond. Compulsory convertible bond. You know why they will buy like that? He feels that I want 14. Anyway they are paying how much? 12.5. So I am losing how much every year? 1.5. 1.5, 1. Like that for 5 years I lose. Whatever amount I lost in the form of lower coupons, that I will recoup it in the form of higher equity shares value. If the par value of the investment is 1 lakh, if you go with first option, you will get 1 lakh only after the end of 5 years. But here you are getting 10,000 shares. This fellow believes that, greedy fellow, after 5 years, it 10,000 shares ka worth will be higher than the 1 lakh rupees and it will cover all my losses in the initial years. And I'll get even more also. With that feeling, he tempts and he accepts a lower rate of interest. Last one. Issues redeemable or convertible debentures at option of holder. Coupon rate 10%. In his mind, how much return is there? Stupid will still go and buy this third bond, even though they are giving a coupon of only 10%. Why? he has a choice now. What choice? If he wants cash, he can take cash. If the company's share price is crazily increased in next 5 years, he will go and select conversion option. But at the safe side, he has the option to take cash also. Company does not perform well, he'll take cash, maturity value, and he'll get out. Now, life loss options are not free. You want a choice, you have to pay. Now, when I passed my 10th standard, I told my father I want to join CA. My father said, you are very fickle-minded. After joining MEC, if you don't like it, you don't have much of options left. So, nobody trusted me to clear CA. So, what they did, they forcibly made me join MPC. So, I studied physics, chemistry, writing this IIT exams and all. My plan is, even if I don't like MPC, I can still join CA later on. But if I like MPC, I can pursue that. Easy settlement. So, that was giving me an option. But I have to put extra effort. Obviously, MPC is difficult than MEC. If you know, you know. So, that was a choice which I made to put extra work. But because of that, I have options. Post MPC, CA also is open for me. Engineering is also open for me. I have choice. People who went for MEC, they don't have a choice. Everybody wants to settle high. So, for an MEC point of view, either you should crack a big B school MBA or CA. So, you don't have much of choices. Now, I have all the choices left. But for that, I have to pay extra work. Choice, not free. Option holder, he has a choice. Free, premium. Like that. A holder wants a choice. He has to pay premium. Sir, where is premium? Accepting lower interest rate is the premium indirectly what he is paying. Okay. Now, focus on the last one. You will understand it better. Market expectation is how much? Now, did this company RIL show or display their equity share from a distance and reduce their interest burden? Did I reduce my interest burden by displaying my equity share from a distance? See, you will get this. Yes, sir. Did I play that game or not? That means our company used our own equity share and avoided a payment. That is how an equity element comes into picture. Option of the holder. The financial liability I will treat the principal amount. Interest anyway financial liability. But overall classification is CFI. Why CFI is whatever 10% you are paying interest compulsorily every year, that is lesser 10%. You should have paid actually how much? So you avoided how much? You ideally should have an obligation to pay 14, but you are actually paying only 10. You avoided 4%, displaying your equity share. That's all. That's how equity element comes into the picture. That's how this entire thing becomes a CFI. Later on when we do CFI questions, you will observe every question invariably a market interest rate and coupon rate will be less, market interest rate will be high. Why like that? Means this is a logic for that. Clear? Okay guys, so that is the story of convertible or redeemable debentures. Okay guys, come here. Now last, after convertible or redeemable debentures, we have to see accounting of buyback. As such, accounting of buyback, only one line is there in the standard. What it says is, when a company buys back its own equity instruments, any gain or loss in the transaction will be adjusted directly in equity itself. I mean to say, so for example, your company has equity share capital, face value is 10. Market price is, let's say, 80. If you offer buyback at 80 rupees, nobody will surrender to you. So you put buyback price as 95. So ultimately it so happened that 10 rupees face value ka share, our company is buying from the existing shareholders at 95. How much extra are we paying? 85 rupees extra we are paying. That's a kind of loss to the company. So the entry what you will pass is equity share capital account debit 10, to bank 95. So this extra payment whatever you are making, normally losses and gains should go to P&L account or PRL section, to be honest. But this is an extra consideration paid to whom? To the equity shareholder. Who is equity shareholder? He is the owner of the company. If the owner takes his money, how can you call it as a loss or an expense? Therefore, this cannot go to PRL. this has to be adjusted only in other equity. Other equity means reserves and surplus. So you will debit this to your securities premium or retained earnings or general reserve. Stay in the balance sheet. Don't call it as a gain or loss. Now you tell me, sir, from your basic level understanding, when in a partnership firm, partner makes drawings, what is the treatment of drawings? You will adjust it from capital. You will reduce it from capital. Will you post it in P&L account? No. Why? He is taking his money. How is it an expense to the business? It's not an expense to the business. He introduced capital. He is withdrawing capital. Like that, equity share capital, reserves, all these are monies belonging to the equity shareholder. They invested money. If they want to take money, they are taking money. You cannot debit this as a loss to your PRL. So all equity related transactions, sir, any gain or loss cannot go to PRL. It has to be adjusted directly in the balance sheet only within the meaning of other equity. The securities premium or retained earnings or capital reserve or sum must to be true, that's your wish. Okay. Now, in our basic level, when we study buyback of shares chapter, we used to write accounting entries like share bought back account debit to bank. Later on a share bought back account we used to kill. We used to debit equity share capital and premium. A premium again we used to kill. First priority, second priority. There is a rule. No? The entire substance, the summary of that entire accounting is this. You will debit your equity share capital, there will be a cash outflow, a difference is extra consideration paid. Since you are paying to the owner extra consideration if you pay, you should not call it as a loss, it is his money. So you will adjust it against his money only. His money is what? Equity. Equity will two heads. Equity share capital, other equity. First one is equity share capital, second line is other equity. So don't bring anything to PRL. That's the whole part of it. So it's about buyback. D point is not important, sir. Leave it for now. Coming to treasury shares. Now, what is the meaning of treasury shares is, though in India it is not permitted, outside India it is quite prevalent. What is this is, suppose, sir, your company is having surplus money. Nobody would like to have idle money in their hand. So they want to invest somewhere. This fellow thought, after a lot of research, I found that my company is best company. So this fellow decided to buy his own company shares and hold it as an investment. Later on, when the price increases, they will sell and make a profit. In India, why it is not permitted? It's almost amounting to insider trading. Your company MD, sir, you know what the company is going to do and all. If I allow you to buy your own shares and trade it, it's like you are cheating public, no. With your insider confidential information, in India it's not permitted. Some countries it is permitted. So, when you buy your own shares, let's say you bought the shares for 1000 rupees. Normally, if it is some other company, we'll write it as investment in TCS company. No, I am A Limited, I purchased A Limited share only. Equity share of another company is a financial asset. Our own company equity share, if you go and buy, that is not a financial asset. Because financial asset definition of what did they say? Equity instrument of another entity is a financial asset, not our own entity. So you can't call this as a financial asset. So then what should I do? The standard law much guidance is not directly given. What they say is adjusted only to equity. So equity account debit to bank. Later on, after 2-3 months, you sold off. Let's say you sold it off for 1400. Bank account debit to equity 1400. What is the difference? 400. Where is that 400 lying? Equity. So gain or loss on trading of your own equity instruments, that gain naturally got accounted in equity head itself. Sir, what is equity debit to bank, sir? See, this is what the standard told. But when you actually read the journal entries, it will be recorded like this. Equity share capital account debit. Let's say you are paying extra retained earnings account debit to bank. You are paying 1000. Face value of equity share capital is 100. Extra consideration paid is 900. Later on, when you sell this, bank account debit 1400. Now that equity shares are held with outsiders, again you can recreate your equity share capital. Extra amount, whatever is coming, adjusted to retained earnings. Now, if you observe, originally retained earnings was debited with 900. Now retained earnings is credited with 1300. So retained earnings is effectively increased by an amount of 400. 400 is nothing but your profit. You purchased at 1000, you sold at 1400. 400 rupees profit. Sir, profit should go to P&L. No, sir, profit should go to P&L when it is a transaction with outsider. These shares from whom did you buy? Your own shareholders. To whom did you sell? Your own shareholders. A transaction with equity participants. Transaction with own equity people will never go into PRL. So again the same buyback wala rule only here. Okay. So that is one small concept here. Next. very important. Transaction cost. Transaction cost means they are incremental costs that are incurred in relation to acquisition, issue or disposal of financial asset, financial liability or equity instrument. See, financial instrument three parts: financial asset, financial liability, equity. In relation to issue of this or in relation to redemption of this, if you incur any expenses which are directly related, they are called as transaction cost. An easy example: you are issuing equity shares. Safe side, you appointed an underwriter. Underwriter ka car will not work without petrol. No, he also wants money. No, so I pay underwriting commission. So from my point of view, accounting entry to bank, debit where? Underwriting commission. If you debit, where will you transfer underwriting commission again? You will write underwriting commission to bank. Next, underwriting commission will go where? Normally, every expenditure should go to P&L account. But this is an expenditure incurred in connection with raising of money through equity shares. Who is equity shares? Own equity instrument. Own equity instrument related cost also must be adjusted in equity itself. You can't take it to PRL. Meaning, like you said, you will use something like securities premium, general reserve, retained earnings, but you will ensure that this underwriting commission will not travel to PRL. So if somebody asks you what is the treatment of underwriting commission, you should ask back in context to what did you incur this cost. If it is an underwriting commission related to issue of equity shares, it cannot go to PRL. It has to be adjusted into your reserves only. As securities premium, general reserve or retained earnings, so that's a different thing. But it cannot go to PRL. So this is the first point, sir. Transaction cost in relation to issue of equity instruments. Cost incurred are directly adjusted into equity itself. The standard will not tell you account name. As securities premium, general reserve or retained earnings, so that is your choice. Okay, given a chance, everybody would like to wipe off securities premium first. That is restricted reserve. You can't issue dividends out of it. But remaining general reserve and all, you can declare dividends to the shareholders and take cash out of the balance sheet. So given a chance, we'll first try to exhaust what? Securities premium. So the choices are there with you, but you can't debit your PRL with that. Next. Sir, what about transaction costs that are incurred in relation to financial assets and financial liability? That will again cover in Ind AS 109. That's not addressed in Ind AS 32. So the standards have split certain accounting here and certain accounting there. 99% accounting will happen only in 109. 1-2% limited accounting is there in Ind AS 32. This is that. Next. Sir, our company issued equity shares. After issue of equity shares, these shares we have listed on a stock exchange. Now that I have listed my shares on stock exchange, I have to pay listing fees. Listing fees I have to pay. No? Our listing fees, what is the treatment of that? Related to own equity shares only. Is it related to issue of equity shares or creating a secondary market? Listing shares purpose is what, sir? Not to raise money. It is to create a second hand market. Existing first one investor purchase share from the company. He does not want it. He want to offload it. He want a second hand market. For that I created a secondary market by listing my shares on a recognized stock exchange. This is not a cost incurred in relation to issue of shares. Therefore, this has to go to PR. Are related to own equity shares, but that cannot be called as a transaction cost. Transaction cost means incremental cost incurred in relation to raising money. This is not that. This is secondary market listing fees. This will go to PRL only. Careful. Next. In enter both the standards, 32-109 put together, on own equity instruments, this is the only accounting you will find, nothing else. For financial assets, big accounting is there. For financial liabilities, lot of accounting is there. But for equity, only one line. Read that. Any contract or instrument, if classified as equity, it will be measured only at its initial value and there would be no subsequent remeasurement. Once you record your own equity at some number, subsequently lifelong you will never fair value it. No fair valuation is allowed for own equity items. Now visualize this, sir. In a balance sheet, asset side revaluations are possible. The financial assets anyway fair valuation is there. Later on we will study. But other than financial assets also, if you take PP, intangible assets and all, for that also fair valuations are permitted by respective standards. Similarly for liabilities also, if you want, you can do fair valuation according to this standard, which I will show you later on. So assets can be measured at fair value, liabilities can be measured at fair value. Other than these two, balance sheet one more hero is there, equity heading. Don't touch any of that with their own fair value. I mean to say, suppose today issued shares at par value, 100 rupees. After 1 year, my company ka share price is 140. Sir, last year I issued only for 100, no, equity share capital I recorded 100 only, now market price is 140, a 40 rupees I'll book a gain and increase the equity share capital to 140, not allowed. Why not allowed? You cannot fair value your own equity item. You can fair value assets and liabilities, but not your own equity. Other company equity, if you purchase it and hold it as an asset, that you fair value, don't have a problem. Sir, you are having Infosys shares as investment, fair value it. But Infosys company cannot fair value their own equity shares. If they are having investment in TCS, they can fair value. They cannot fair value their own equity. Why do you think it is like that? Who wants all that, sir? Rule is rule. Tell me, why do you think it is like that? Why can't you fair value your own equity? What could be the reason for that? Simple. Last year share price is 100, today's share price is 140. You tell me why share price increased from 100 to 140. Logical reason. Don't tell me Rahul Gandhi became PM. Normal. Correct reason. Company earned profit very well. That's the reason share price might have increased. If company has earned profit very well, a profit is there where? P&L account. From P&L account it flowed to balance sheet. Where is it sitting? Under other equity it is already there. No. Why should I again update my equity share capital with that? Correct, no sir. If your company has made extraordinary profit, a profit is already accounted, no. A profit is sitting under equity head only, no. With the name of other equity, retained earnings it is there. Why should you fair value again your equity? The reason for your increase in share price is already accounted with you. That's why you should not touch it. Suppose you give me another reason. No sir, my assets value has increased. That's why my share price has increased. Is it so? In that case, go and fair value your assets. Who is stopping you? Revaluation models are there in PPE standard, intangible asset standard, all financial assets. If you want, you can measure it FVTPL. Do that. But don't touch your own equity. Because the reason for change in your equity value is already accounted, or it can be accounted if you want to do so. And no sir, we won a project. Cash flows will come in future. So today's share price has increased. So when that cash flow comes in future, your company will make profit. The profits automatically will be accounted in your books. So whatever reason you tell me, that reason is either already accounted or will be accounted in future. That's the reason own equity should not be fair value. It's a very important principle. Next, coming to interest and dividends. Treatment. Sir, on financial assets, interest and dividend is an income that will be accounted in your PRL. Sir, this is the language of the standard. PRL, not P&L. PRL section, first part. Interest and dividend on financial liability, that's an expense in PRL. Interest and dividend on own equity instruments. Sir, tell me what is the entry for dividend declared on equity shares? You declared dividend on your own equity shares. Tell me entry. Bank account debit. Okay, fine. Retained earnings account debit to dividend payable account debit to bank. What is the effective entry? Retained earnings account debit to bank. So what is the entry you learnt unknowingly? Retained earnings we are debiting, cash outflow bank we are crediting. Because you are giving money to your own owners, how can you call it as an expenditure? They are taking their money, so you have to debit it to their reserves, not to P&L account or something. So the entry would be directly adjusted to equity. Retained earnings, general reserve, anything is fine. You directly adjust into equity. Last part. Correctly understand. I issued a debenture, mandatorily redeemable financial liability, but interest is discretionary. Mandatorily redeemable debenture, pakka have to repay the principal, but interest is discretionary. This is compound financial instrument. In a particular year, I paid this interest voluntarily, discretionarily. I declared, I paid. Since I paid to bank, I paid to whom? Debenture holders I paid. Am I having obligation to pay? No, but I still paid. Where should I debit it? Is it obligation to pay which is satisfied or discretionary payment? Discretionary payment. A similar discretionary payment is what? Dividend on equity shares. Dividend on equity shares, what did you do? You debited to retained earnings. This also debited to retained earnings. You might have paid it to debenture holder only, but it is not an obligated payment. It is a discretionary payment. It cannot go to PRL. It has to be adjusted to retained earnings reserve, so you will have to adjust this. Clear here? Now, there are a couple of star marks here if you see closely. The financial assets ka interest income, dividend income normally will go to PRL. Similarly, financial liabilities ka interest and dividend expense normally will go to PRL. But if any Ind AS requires otherwise, you will follow any other Ind AS. Example, you took a loan. On that loan you are paying interest, but that loan is used for construction of a qualifying asset. Borrowing cost capitalization. There is a standard, no? What does it say? interest on that loan should be capitalized to the cost of the asset. It should not be transferred to PRL. There is a specific standard that says the rate don't come to PRL, directly go and add it to the asset cost. In that case, you will ignore the standard and apply Ind AS 23. Similarly, you borrowed 100 lakhs at the rate of 10% for construction of a qualifying asset. It's not like enter 100 lakhs, you will spread in the project on the first day, no. You use some 30 lakhs. Remaining 70 lakhs you parked in some temporary investment. A investment gave you income. So that's an income earned on investment. According to the standard, that should go where? PRL. But what Ind AS 23 says is, when you are having a specific borrowing, a specific borrowed funds are temporarily invested somewhere, and that investment is giving you certain income. What you have to do is compute the total borrowing cost, from that minus that income, net borrowing cost only should be capitalized to the cost of the asset. That means indirectly what is happening? The interest income also is getting reduced from the cost of the asset itself. That means I am not taking it to PRL. So that kind of any exception is there, that exception will prevail. Otherwise, general rule is all these things will come to only PRL. So that's what the standard says. Next. Offsetting a financial asset and a financial liability. This question came in before last attempt exam. Offsetting a financial asset and a financial liability. Now, to start with basic example, now watch this, sir. Our company name is A Limited. We have a debtor 3000 or 300 rupees receivable from a company called B Limited. In some other transaction, I owe money to B Limited of 100. So I have to receive from them 300, I have to pay to them 100. Parties are same only, A and B ka transaction. Do you all agree? No, this is a financial asset. This is a financial liability. He is asking, can I show net debtor? Net debtor ka meaning is, this is presented as a reduction here, 100, and net I will show 200. Can I do like that? Parties are same. The standard says you can do offset, presentation purposes ka offsetting is permitted, but two conditions have to be satisfied. Two conditions. Number one, you should have a intention to do settlement on net basis. Intention to do settlement on net basis means what? In future, instead of I collecting 300 and instead of I paying 100 separately, I should be able to receive only net 200 rupees. Our intention we both should have, number one. Number two, it should be legally permissible also. That means your intention is there, but legally restriction also should not be there for that. If these 2 points are satisfied, net presentation is allowed. Otherwise, it is not allowed. Now, normally, sir, when you see this kind of example, since parties are same, if they both want to do net settlement, legally there won't be any restriction directly, usually. But just because parties are same, does not necessarily mean that they will do a net cash or net settlement. Why? Imagine, sir, I am A Limited, you are B Limited. My debtor amount is due tomorrow morning. You have to come and pay me 300. But I owe you 100 after 3 months. Tomorrow morning, if you come and give me 200, I will accept. No. I owe you 100, but 100 ka due date is different. 300 rupees ka due date is tomorrow morning. Tomorrow morning, if you come and offer me 200, I will not accept. Legally permitted, but I will do net settlement. No, I won't do. When anyway you are not going to do net settlement, why to present it on a net basis? Show them separately. That's the logic behind that. Intention is important. Second thing, even this. I took a loan from ICICI Bank. I owe them 300 crores. I had some surplus money. I invested in ICICI bonds only. What is loan? Payable to ICICI. What is bond investment? Receivable from ICICI. Now, can I show net loan of 298? Yes, sir. Can I do net settlement? There, a loan separate, bond is separate. Correct? No. Moreover, legally also it is not permitted. So, just because parties are same, automatically it should not issue. So, two conditions are there. Legally enforceable right should be there, and parties should have intention to settle on a net basis. There is a small carve out on a concept called as foreign currency convertible bond. Subject to time, I will discuss later on. This question also is not there, so I just don't want to unnecessarily go into detail. It's a very interesting one, but we'll see subject to time. Even this one also, questions are not there. Now coming here, exclusions from Ind AS 32-109. Very important, sir. In this, couple of exclusions are really important. You tell me, sir, investment in equity shares, is it a financial asset? Investment in equity shares of another company, definitely financial asset. But you see this, investment in equity shares of subsidiary, joint venture, associate, they are scoped out of the standard. Even though they are financial assets, they are not covered under the standard. Why, sir? There is a separate standard for that called as Ind AS 27. Ind AS 27 ka title is separate financial statements. If you go to that standard, that fellow will tell you how to do accounting of investment in equity shares of subsidiary, associate and joint venture. This standard asks you to get out now. When you go to Ind AS 27, you know what he says? You have two choices. Number one, cost. Number two, follow Ind AS 109. That fellow will again kick you back to 109. If you really badly want to go to the next page, first go to Ind AS 27, then get kicked from there to here 109. Ultimately, if you want, you can apply also, to be honest. Next. Suppose you tell your customer that I'm selling a product, if the product does not function well, I'll refund you the money. It's a kind of a warranty obligation. Okay. So here you have contractual obligation to deliver cash. So ideally it satisfies the definition of financial liability. But you have a specific standard called as Ind AS 37 for provisions. Our standard covers. So E particular standard is not applicable for warranties. Next. You are issuing some shares and all. You are acquiring some assets and all in the course of a business combination. Amalgamation process, you have incurring some issue cost and all, you are incurring some issue cost on issue of shares and all, or you are taking over some assets, financial liabilities. At what values you should record? Ind AS 103 says. So again, this standard is not applicable. These three cases are important, sir. On remaining, you don't even see any application also. Investment in equity shares of subsidiary, associate, joint venture are not covered here. Warranty obligations are not covered here. Business combination related transactions are not covered here. Except these three, remaining you will not see anywhere, sir. No question will be there on that, so you not bother much about it. So that is the end of our Ind AS 32, sir. The first part of the standard. In this, what we learned is, we learned the definition of financial instrument. We have seen financial asset, financial liability, equity. Then we saw that there is a derivative instrument. Derivative can be classified as a financial asset also, financial liability also, equity also, scoped out also. Then we have seen contracts, which are contracts to buy or sell non-financial assets on a future date. A copper wala example. For that entire summary is, if the contract is only going to be settled by way of physical delivery of non-financial asset, you are scoped out. If it is going to be settled by way of net cash, then you are covered under the standard. Only that much. If option and all is there, check your past history and current intention and then decide. After that, we went into fix it to fix it test. What two things should be fixed? Number of shares to be issued should be fixed. Value of consideration to be received also should be fixed. If these two things are fixed, a contract is classified as a own equity instrument. Now you can link up. What is the advantage of becoming an own equity instrument? If it is an own equity instrument, accounting will happen only once at once. That too directly in the equity. You will never ever fair value it. You will never take anything related to that into your PRL. So that is the ultimate advantage of becoming an equity. Equity, there is no subsequent remeasurements. All gains and losses are recorded only in equity itself, if at all something is there. So that is F2F test. Then after F2F test, we covered compound financial instruments. Compound financial instruments are contracts where you have the character of equity also, financial liability also. Accounting we will discuss later on. Then we have seen how to do accounting of a buyback. We learned how to do accounting of treasury shares. Then we went into the concept of transaction cost. Transaction cost related to own equity instruments cannot go to PRL. It will be adjusted in equity itself. Up to there we have covered. Then we went into the concept of offsetting. Financial asset and financial liability can be presented on a net basis if the parties intend to settle on net basis and it is legally permissible to settle on net basis. So that. And then we discuss the treatment of interest and dividends. Interest and dividend income on financial assets recorded in PRL. Interest and dividend expense on financial liability recorded in PRL. Interest and dividend on own equity instrument should be recorded in equity itself. Discretionary payments are also recorded in equity itself. Right? So up to here we have covered, and these are scope exclusions, sir. So now we are good to start the next standard, which is Ind AS 109. Ind AS 109 is the main standard of financial instruments. I made a small summary here. This will give you an overall view, sir. Observe this. Equity accounting we will not talk now. We have only two things to talk. Financial assets accounting, financial liabilities accounting. If it is a financial asset, in this entire standard, you have only three methods. One is amortized cost method, which we call it as ACM. Second one is called as fair value through profit or loss, FETPL. Third one, fair value through other comprehensive income, also called as FETOCA. So a financial asset can be accounted in any of these three methods. This is not your choice, sir. Which method when you have to apply, the standard has a detailed guidance on that. But as such, how many methods are possible? Three methods are possible. When it comes to financial liability, only two methods are possible: ACM and FETPL. Which means what, sir? Overall, you have to learn only three methods: ACM, FETPL, FETOCA. But for asset, all three are applicable. For liability, only two are applicable: ACM and FETPL. Okay. Now, what we will do is, we will learn the ground rules of each of these three methods. See, we will not first go and attack financial assets and all. See, there are two ways from here onwards, sir. First, you learn how to apply each method, and then learn which asset, which method you have to apply. That is one way of doing it. Or, first I will tell you for which asset, which method is applicable. Then we will see what is inside the method. That's how the second model is there. No? That's what StudyMat has followed. Okay, a method one flaw is there. What is that flaw? Is when I teach you that for investment in equity shares you have to apply FETPL. You will ask me why. If I say for a particular set of conditions you have to apply only ACM, you will ask me why. And I can't convince you because you don't know what is there inside ACM method. So we will do the reverse process. First we will see, as in ACM what will happen, in FETPL what will happen, in FETOCA what will happen. And I will give you 2 or 3 examples where I myself will ask in the question, do ACM, do FETPL, do FETOCA. First to become pro in that. Understand how to apply these three methods. Once you understand these three methods, when to apply which method is very easy and logical to understand. Okay, so let's start with the ground rules. Follow here, sir. Amortized cost method. Look at the name. Cost and a word is there. Indirectly, that means that fair valuation is not permitted. Okay, the initial recognition of financial asset or financial liability will be done at fair value, including the transaction cost. What fair value is there? At initial recognition, it is recognized on the very first day at what value? Fair value, along with the transaction cost. I'll give you 2 examples, you tell me entry. I purchased investment in the market, 100 rupees fair value I bought. I paid brokerage of 2. Total how much did I pay? 102. Tell me entry now. Directly, investment account debit to bank, 102, 102. Is that 102 fair value? No. 100 is fair value. 2 rupees is transaction cost. If 2 transaction cost is adjusted to the fair value and will record the entry. Financial asset ka initial recognition and transaction cost is already loaded into that. Okay. Next example. I took a loan of 100 crores. I paid 1 crore processing fees. So net I received how much? 99. Tell me initial recognition entry for this loan. Bank account debit 99. To loan 99. Sir, earlier transaction cost you added. Now you are deducting it. Why like that? Sir, it's not about adding, deducting. You see the cash flow come movement. Earlier, 100 rupees was outflow. 2 rupees also outflow. So I added both of them. Loan case, sir, 100 was inflow, 1 was outflow. So I netted them off. So, including transaction cost means not adding or not minusing. It depends on case to case basis. Are you getting it, sir? I gave a loan of 1 crore, or let's say I gave a loan of 100 rupees to you. I collected processing fees of 2 rupees from you. I gave 100, I received 2. Net I gave you 98. So loan receivable should be recorded only at 98 starting point. Okay, this first point. Second point. The interest income or the interest expense will be recognized using effective interest rate method. Effective interest rate method is nothing but indirectly IRR. Interest expense or interest income should be measured using IRR. Indirectly is asking you to follow compounded interest model, sir. IRR accounting will happen in this. Interest income, interest expense. Now, how it will happen, I will show you detailed. Continue. And there will be no subsequent revaluation. What is the meaning of it? First day you recorded fair value along with transaction cost. Every year you recognize interest income, interest expense. And on the balance sheet date, there is no fair valuation. Method, name a what method? Cost. There is no subsequent fair valuation. That's all. ACM ka 3 rules are over for us. Let it be financial asset, let it be financial liability. Rules are only this, these are not going to change. Next. Fair value through profit or loss. See the name, fair value through PRL, profit or loss. Now, you can guess easily now. initial recognition should be done at, what is the name? Fair value. So initial recognition also is done only at fair value. Sir, what about transaction costs? They will die in PRL. We will not mix it along with the financial asset or financial liability, because this name, method of the name itself is what? Fair value through profit or loss. Now, I purchased investment for 100. I pay transaction cost of 2 rupees. Entry will be investment account debit to bank 100, expense account debit to bank 2. Expense will go to PRL. Either if you are applying ACM, entry would have been investment to bank 102. Under FVTPL, initial recognition should happen only at fair value. Transaction cost should go to where? PRL. Right. Next. In ACM, interest income, interest expense was measured on EIR, effective interest rate basis. Effective interest rate is nothing but IRR. You should not apply IRR concept while doing FVTPL. So whatever coupon interest income or coupon interest expense is there, directly will book it in your PRL. No concept of IRR drama there. Next. In ACM, on every balance sheet date, there is no subsequent remeasurement. But here we have subsequent fair valuation. Method A, fair value method. No, so obviously on every balance sheet date, your financial asset or financial liability must be measured at fair value. Whenever you fair value it, pakka gain or loss will come. A gain or loss will go to PRL. PRL means what? First part of your P&L account. It will go there. Clear? Next. Fair value through other comprehensive income, also called as FET OCA. Now, the initial recognition of financial asset will be done at fair value including transaction cost. Wait there. E point is just similar to what? E point is just similar to ACM. ACM, whatever initial recognition principle is there, FET OCA initial recognition principle also is same to same. Next. If the cash flows of financial asset are in the nature of interest and principal, that means you are having interest incomes, then for that interest income, again you will apply what? EIR. And it should be same as if you are following which method? ACM method. If you are following ACM method, whatever interest income you are recording, even under FETOC also, same interest income will come. What is the moral of this is, ACM ka first 2 points, FETOC ka first 2 points are same to same. ACM ka third point is what? No subsequent revaluation. Can I say that here? No, here name a fair valuation. So obviously on every balance sheet date you have to do a fair valuation. When you do fair valuation, you will definitely have a gain or loss. Where will it go? OCA. It cannot go to PRL. It will be parked as a separate reserve in the balance sheet. But before coming to balance sheet, it will once say high in P&L account bottom section. And from there it will enter into balance sheet. OCI item means directly balance sheet separate reserve. But before coming to balance sheet, it will once go to P&L account ka second part, say hi there and then come to balance sheet. Clear, sir? Now read third point. On every reporting date, the financial asset is fair valued and resulting gain or loss is recognized in OCA reserve separately. The gain or loss so accumulated in OCA may or may not be reclassified to PRL subsequently. What's the meaning of this? Sir, if fair value gain what you are getting, are you understanding the unrealized gain or unrealized loss? One day in future it will be realized. When it will be realized in future, you can merge it into retained earnings in some cases. Sometimes you may have to transfer it back to PRL. So that is called as the reclassification concept. Clear, sir? So these are the ground rules of these three methods. Now when you apply these methods, I am telling you the most easiest one is FETPL. And among these three, difficult one is FETOC. Sir, what about ACM? Sir, that is your starting point, sir. You understand ACM very well, instruments will become your friend. It is like that. 2 examples, sir. Give me time. You will become pro. Watch this. A Limited has issued 9% debentures, face value 100 each, at 5% discount. So 100 rupees face value you issued at 95. Coupon rate is 9%. These debentures are redeemable after 3 years at par value. So issued at discount but redeemable at par. Show the accounting applying ACM. EIR is 11.048%. Question they gave of the EIR. Okay. Now, what is it trying to say is, a 3-year debenture, sir. Today you issued the bond at 95. You raised 95 rupees. Bond life is 3 years. Here you have to pay coupon Here also you have to pay coupon. Here also you have to pay coupon. Here along with coupon you also have to pay maturity value also. Your coupon rate is given as 9%. 9% you have to apply on the face value. So it is 9 rupees outflow, 9 rupees outflow, here 9 rupees outflow, maturity value redeemable at par 100 rupees outflow. So total outflow at the end of third year is 109. Now carefully watch. You received 95, but overall you are paying more than 95 now. 99927 plus 100, 127 you are paying overall. If I ignore time value of money, you raised 95, but repayment you are doing 127. You are definitely paying more than 95. That means some interest you are paying, no? Compounded basis, I want to know how much interest are you paying. Now you should not go and tell me, sir, our interest rate is 9%. It is stupid contracted rate, sir. Under the contract, I am liable to pay you 9% interest. But my actual cost is not 9%. It is much more than that. Why? Imagine, sir, I did not issue the bond at discount. I issued at par. Tell me now. I raised how much? 100. I am repaying how much? 100. Last. In between I am paying 999. Coupon rate 9. My actual cost also is 9. But in our example, I did not raise 100. I raised only 95. Because of that, my actual cost won't be coupon rate. It will be much higher than the coupon rate. Sir, how much is that I want to know? For that, you have to apply IRR technique. What is the discounting rate at which the present value of all the future cash flows will become equal to 95 rupees? A discounting rate, trial and error, you work. You know it's more than 9. Try at 10, fail there. Try at 11, fail there. Try at 11.5, fail again. Now sit and interpolate. And you will ultimately work out that it will be 11.048%. This is your effective interest rate. Sir, this is IRR, no sir. Why are you calling it as EIR? One more name unnecessarily. Call it as IRR only. IRR ka full form is what? Internal rate of return. Is investment, borrowing. Borrowing. On borrowing you will have return. So I want a neutral name. That's why IRR in a word I don't use. EIR is a neutral word. It's neither return nor cost. Whatever it is, whenever it is, we can use like that. That's why standard does not use the word IRR. They call it as EIR, neutral word. But concept is IRR only, sir. Okay, so EIR. Now, debentures, financial liability. If you have calculator, can help me. If you don't have, then I'll have to help myself. Yeah. Sir, on these debentures, if I am applying ACM method, tell me. You will tell me initial recognition principle now. Initial recognition principle. Recognized at fair value including transaction cost. I don't have any transaction cost. So I raised how much? 95. So directly first entry will be bank account debit to debentures 95. So I will write by bank. Okay, first day accounting is over. Next, what is the second point of ACM? Interest income or interest expense should be measured using EIR. Normally, sir, even if you don't know any instruments, what is the entry for interest paid according to our C enter? Interest account debit to bank. It is when you pay interest. If you don't pay, interest account debit to interest payable, accrual concept. We will record this entry, correct? Now what we will do under ACM method is, we will record the second kind of entry. We will book an expenditure and we will create a liability. And we will not create a separate liability. This also we will go and credit it to debentures only. And this we will credit with what amount? EIR amount. So at the end of year 1, the entry I will record is interest expense account debit to debentures. So in debentures account, how will it fall? By interest expense. Sir, amount, you raised 95. On that your cost is 11.048%. Please tell me the number, sir. 10.49 is 49 only. Or 5.1. 10.5 exactly. Okay, fine. Leave it. My bad. Leave it. So, I borrowed 95 and I owe you 10.5. But by the end of first year, am I paying something to you? How much am I paying? 9 rupees. To that extent, my liability should come down. So, my entry now should be financial liability, or in this case, debenture financial liability account debit to bank. 9 rupees. So in debentures account, I will go and write to bank 9 rupees. Now watch this carefully. According to legality point of view, this is interest. Legally, I owe you how much? 9 rupees. So this is what people call it as interest. Layman. You are not layman, you are pro. For you, this is interest. Interest means that number which is measured using EIR. Proper compounded interest I want. Not your legal payment. This is contractual cash flow. This is EIR interest. This is interest, sir. This people call it as interest, but this is not interest for me. This is only a cash flow for me. Okay, now. Tell me the closing balance. 96.515. Okay, with this I am done with first year. When I come to second year, my opening balance is 96.5. End of second year, by interest expense. In 96.50 into 11.048%. Please do it, ma. 10.6, 6666 like that, huh? Exactly 66, huh? Okay, fine. Then, to bank. Again, you are paying how much? 9. So, you still owe to your debenture holders how much money? 1.6. So, with this second year also I am sorted. Now, come to third year. I'll start this with 98.16. Third year ending, again I have to record what? Interest expense. Interest expense, how will I get? 98.16 into 11.048%. Now, just keep on with that number. We have a small issue with that number. Come here. Is it the last year? Once I make the payment here, do I owe anything to anybody in this world? No. So, we should have a clarity that your final closing balance is going to become 0. And this IRR and all, whatever rates are there, usually they are approximate rates. They won't exactly match dot to dot, pin to pin. Okay, some approximation may be there. So when you come to last year, no, don't work out interest first. That is simply, we wrote in the bracket like that. Don't post that number anywhere. What you do, it is certain. 9 I have to pay, 100 I have to pay, and after I pay 109, the account should die. So you will take this as a balancing figure. 10.84. Sir, I worked out, I also got same numbers. Pure coincidence. Means not coincidence, it's supposed to be same, but generally small approximation error will come, sir. Okay. Ideally it should match, sir. If your EIR is perfect, it will match. But it will be hardly perfect. Generally it won't be, small error will be there. So they take it as balancing figure and close it. Okay. Now, the entire account, sir, we will have learned some entries. Tell me, what's the first entry you wrote? First entry, bank account debit to financial liability. Some amount. Each year you tell me. Each year two entries you wrote. No, numbers I don't want now. Skeleton entry. Interest expense account debit to financial liability and financial liability account debit to bank. Sir, these two entries are recorded with same amount or different amount, sir? This is recorded with EIR. This is recorded with contractual cash flow. According to contract, how much I agreed to pay, that much. And on every closing date, did I fair value? On every balance sheet date, did I fair value or the account simply balanced it? Simply balanced it. There is no fair valuation. That's all, sir. This much accounting only. You repeat, our account will collapse one day. It will become 0. That's all is there in ACM. Entries carefully remember, sir, only this much will be there. Easy only. Am I clear here? Now, I have some observations. Watch this. What is the contractual interest rate? 9%. This particular sum, sir, debenture is issued at par, discount. Discount. Because of that, my cost of borrowing has increased, no? I received 95, but I have to repay how much? 100. So, even though technically interest rate is 9%, in substance real interest rate is 11.048%. So, your EIR is 11.048%. Now, they both are not same. Why they both are not same? Simple, because the bonds are issued at discount. Imagine, sir, here it is 100. I raised at par value. Then, my coupon rate is 9. My EIR also would have been 9%. If my coupon rate and EIR both are same, you know what will happen? Come here. The account carefully observe. The starting number would have been 100. 100 into 9%. This would have been 9. I would have paid 9. The closing balance would be 100. Next year opening balance would be 100. On that 9. Again I would pay 9. The closing balance again will be moral of the story. First day whatever number you record, our number will continue as closing balance every year. When your EIR and coupon rate both are same, opening balance and closing balance of each year also will be same. Our case rate is not same because our EIR and our coupon rate are not same. If you go and ask, sir, why you people are not same? Why people are not same? Because bonds are issued at discount, redeemable at par. That's the reason they both are not same. Sir, bonds are issued at par, redeemable at par, no transaction cost also. In that case, coupon rate and EIR both will match. Suppose same sum, sir, if I change like this. I issued bonds at par only. I raised 100. But I suffered transaction costs of 5. Bond issued, I received 100. But I paid net inflow. In that case also my answer will be exactly like how I did. Issuing at par is not sufficient. Transaction cost should be 0. Then only EIR and coupon rate both will match. Now why I am telling you all these mathematical observations is, sir, later on when we go deep into the chapter, there are certain questions like loan restructuring and all. That fellow will restructure the loan in the 8th year of loan. Now what is the balance of on that day? Our question you will observe that EIR and coupon rate both are same. So first day whatever balance is there, every year same balance will be there. So you will not prepare a ledger account for all the 8 years and all. Directly you will fatafat write the number. To save time, I am asking you to observe now. Okay. Next. Last point, sir. With that, ACM for this liability will be over. Now, instead of preparing that entire ledger account, we can prepare a small, cute ACM table. ACM table is the account only in a tabular format. So 1, 2, 3. Opening balance of financial liability. We recorded at what value? 95. To that, interest expense based on 11.048%. To that, we paid some cash flows. If you pay cash outflows 9, 9 and 109. Lastly, it should become 0. First year interest you told me something 10.50. Closing balance of first year will be 96.50. That will become opening balance of next year. Then it will become 10.66. 10.66. Then it became 98.16. In 98.16 is opening balance here. On this 10.84 you paid, and naturally the closing balance towards the end is becoming 0. ACM table is a shadow or a skeleton of this entire ledger account. If there are 10 questions in your study mat, 9 questions they'll ask you only ACM table. But there is one question where they'll ask you entire ledger account. Some stupid will ask a journal entry in the exam. Suddenly we should not be searching there. So we should know both. You should be good this way also. Okay. Now, I have a small query, answer this. Is this 95 representing the present value of these 3 cash flows? Is 95 the present value of 9, 9 and 109 discounted at 11.048%? If you say no, I don't know where I'll bang my head now. Okay. So in 9, 9 and 109 ka present value is 95. When you discount at what rate? 11.048%. That much clarity we should have, no? Okay. Now come here. If 95 is the present value of these 3 cash flows, then 96.5 is present value of these 2 cash flows. Yes or no? Yes. Then 98.16 is present value of 17. It will 100% match. If you want, you can try and see. 100% will match. Rounding error may be there, but as such it will match. That means when you are following ACM on any given day, the closing balance will be equal to the present value of future remaining cash flows discounted at your EIR. The very, very, very powerful observation. Why? I'll tell you. Later on, sir, we'll be doing some deep questions where Loan life is 20 years. Modification of loan is happening in 12th year. Okay, so 12th year lo what carrying amount is there? How will you know? Coupon rate EIR, if both are same, then I will apply starting amount and ending amount will be same. They both are not same. No. You will prepare 12 years ka ledger account. 12 year ka ACM table you draw. Now be smart. 20 years la 12 years is over. Remaining life is 8 years. 8 year ka cash flow discount it. Apply annuity factor and all. One line you will get the closing balance. Single shot la answer will come. You need not prepare 12 columns ka ACM table. You need not prepare 12 years ka ledger account. One single mathematical number you can work it out. Under ACM on any given day, the closing balance will be, should be, has to be equal to the present value of future remaining cash flows discounted at your original EIR. So very, very important observation. This only ACM it will work, not in any other method. Clear? Right. E points only I wrote here. E entries ka skeletons we have given, ACM table we have drawn, and this. The closing balance of FI or FL under ACM will always represent the present value of future cash flows discounted at effective interest rate. It's a very, very important summary point. Next. We'll try this one also. A Limited has advanced 1 lakh rupees loan to B Limited on 1/4/2015. This fellow gave loan of 1 lakh. It collected processing fees of 10,000 rupees from B Limited. 1 lakh I gave, another hand to 10,000 rupees I collected immediately with the name of processing fees. The loan carries an interest rate of 10%. The loan is repayable at 3 years at a premium of 5%. How much loan did I give? 1 lakh plus 5%. Repayment time, that other fellow will give me 105. Show the accounting in A Limited for all the 3 years using amortized cost method. EIR is 15.87%. EIR is given in the question. They are asking you accounting for this. Now, this is a loan given, sir. So it's a loan receivable, financial asset, which is getting accounted at ACM. Sir, who told you that it's ACM? Question told. Really, when should you apply? That I will tell you later. Tell me, sir. ACM initial recognition principle. ACM initial recognition principle. Fair value adjusted with the transaction cost. Transaction cost in the sum is how much? 10,000. I gave how much? 1 lakh. 1 lakh is an outflow. Transaction cost paid or received? Received 10,000. So effectively 90,000 I gave, netting off, correct? So my first entry will be loan receivable account debit to bank with an amount of 90,000. How did I get 90,000? 1 lakh I gave, 10,000 rupees I received, effectively it is 90,000. Some people what they do is, they write 1 lakh here and they again write buy bank 10,000 here. That also will have the same impact, same effect. But I advise not to do that. Why? Next you have to compute interest, no? Interest you go and apply on 1 lakh. Gone some there only. So next 3 years nobody will study. There only clarity came. So just for showing separately you are capable of making bigger mistakes. So directly write the net entry itself as always safe. Okay. Now coming to the end of first year. End of year 1. Tell me, sir, interest expense or interest income should be recognized using EIR. Tell me, what is the entry for interest received according to our olden days? Bank account debit to interest. Interest not received. Then interest receivable account debit to interest. Interest receivable is an asset only, no? Now instead of creating a separate interest receivable, directly debit it to loan receivable financial asset itself. So the entry will be loan receivable financial asset account debit to interest income. Sir, with what amount? 90,000 into 15.87%. Tell me the number, sir. 14,283. Good. Now, by the end of first year, that fellow will give you some cash. Now, how much cash will he give me? If you see, what's the coupon rate? 10%. He will apply 10% on what number? 1 lakh. Legal contractual interest is 10,000 rupees. So, even though 14,283 is your income, you are getting only a cash of 10,000. So, by bank you will record 10,000. Closing balance is 94,283. 1 year is completed, sir. Second year. Opening balance 94,283 to interest income. 94,283 into 15.87%. Please do this, ma. 963. Again in second year ending, I will collect a cash flow from that boy to the extent of 10,000. E gap how much, ma? 108, no, 98,000, 99,246. So this is my closing balance. You understand, sir? E closing balance, whatever is coming, that is simply balancing figure. That is not a fair value and all. If you want fair value, no sir, you have to bring market interest rate and discount. I never went to market. I simply did a closing balancing figure. Finally, last year, to opening balance 99,246, to interest income 99,246 into 15.87%. Remember the last year, so don't write that number. By bank, whatever you are collecting, I am collecting how much now? My coupon of 10,000, my original amount given 1 lakh along with premium 105. So total I will get 1,15,000. And once I get this, I don't have right to collect any more cash flows. My financial asset is gone. So 115,000. Here also 115,000. Balancing firma. 15,750 for a. This is your interest. This is ACM for a financial asset. Sir, ACM ka rules are common, sir. We don't differentiate between whether it is a financial asset or financial liability. Rules are same. When you should apply ACM to financial asset, that is a different discussion. But ACM accounting is same. Okay. Now, summarize the entries here. What's the first entry you wrote? Bank account debit to, financial asset account debit to bank. The initial recognition entry. Then every year you wrote two entries. What's the interest income entry? Financial asset account debit to interest income. And bank account debit to financial asset. And every year ending, no subsequent fair valuation. That's all. If you go on following this, our account neatly will become zero. That's all ACM is. ACM you have to understand one powerful observation that the closing balance on any given day will represent the present value of remaining future cash flows discounted at your original EIR. Now, I am highlighting only the cash flows. Watch on the screen. First year ka cash flow is how much? 10,000. Second year ka cash flow is 10,000. Third year ka cash flow is 1,15,000. Now, by the end of first year, what is my closing balance? 94,283. In 94,283 is representing the present value of 10,000 and 1,15,000. Discounted at what rate? 15.87%. 100% it will come, sir, if you want to match and see. Your patience, how much you want to do. Say 100% work out, sir, unless your EIR is wrong. 100% will match. Okay. So this is how ACM goes on working. Now, come to one question, sir. Come to next example. Watch this. It's a very simple example. On 1/5/2016, A Limited purchased an investment in equity shares of X Limited, at 40,000. Transaction cost also paid 2,000. Share investment. The fair value of shares on different dates is as under. First month ending 48,000. Second month ending fair value is 45,000. Third month 38,000. So you purchased for 40. Transaction cost 2,000 you paid. First month ending fair value, second month ending fair value, third month ending fair values they have given. He is asking, show the accounting of this investment assuming FETPL and FETOCA. First and foremost thing you observe. Is it bond investment or share investment? Share investment. In this interest income accounting will be there or will not be there? Will not be there. Interest income accounting will be there when there is a loan transaction. Is it loan? It's not loan transaction. It is share investment. You will not have interest and all. So EIR drama and all will not be applicable here. That's the reason he is not even asking you to apply ACM method. He is directly asking you to apply which method? FETPL and FETOCA. Let's all first talk about FETPL. Tell me, ma, FETPL ka initial recognition principle. Fair value with the transaction cost? Only fair value. So what is the fair value here? 40,000. So entry will be investment account debit to bank with an amount of 40. Or 2,000 directly go to PRL. Don't bring it to financial asset account. Correct? So investment will be appearing at what value? 40,000. By the end of first month, what is the fair value? 48. So my closing balance should be how much? 48. But already how much is there? 40. So I have to further update by 8,000. So 8,000 is gain or loss? Gain. So entry will be investment account debit to PRL. PRL gain, so I'm directly transferring it to P&L account. So what accounting ledger point of view, how I did is, I recorded 40. I know that my closing balance, the desired number should be how much? 48 fair value. A gap whatever is there, I went on throwing it off to PRL. So next year opening balance will be how much now? Again 48. So sorry, next month. Next month ka closing fair value is how much? 45. So I write 45 here. This is my balancing. 3,000 rupees loss. Third month, my starting point is 45. Ending fair value is 38. Again gap 7,000. Where will it go? PRL. Every gain, every loss will go only to PRL. Clear? Now, you watch the same thing and tell me how will it be different if it is FETOC? FETOC initial recognition principle says that transaction cost should be part of your initial recognition. You paid 40, you paid 2. Total you paid 42. Investment initial recognition will happen at 42. Investment initial recognition will happen at 42. Fair valuation is common only, no? At the end of first year you fair valued. To how much? 48,000. How much gain did you get? 6,000 rupees gain you get. This will not go to PRL. It will go to a separate reserve parked under OCI. So we'll call it as OCI reserve. Second month, third month accounting will be similar, sir. Instead of PRL, you will be transferring the losses to OCI reserve. FETPL and FETOC both will be same, sir. Only thing is fair value gain, instead of going to PRL, it will go to a separate OCI reserve. And initial recognition principle also is not same. Initial recognition principle is there it is fair value, here it is fair value with transaction cost. That's all. Sir, unnecessarily people make some stupid tables and all to teach you this method. This is the most easiest way. If you observe, ACM ka first two principles, FETOC ka first two principles are same. FETPL ka last principle, FETOC ka last principle are same. Their fair valuation, here also fair valuation. They will go to PRL, here it will go to OCI reserve. The much more very simplified version. Okay, now, if you once go back to the rules what we discussed, please read B point again for FETOC. If the cash flows from financial asset are in the nature of interest and principal, the interest income shall be recognized on EIR basis. So when you have to apply EIR, when cash flows are in the nature of interest, the example what we just now solved, in that interest is there, interest will not be there. Why it will not be there? That is a share investment. Share investment is not a type of asset where you get interest income. That's why B point you could not apply here. Now later on, after some time, I'll show you a question where it is a bond investment which is measured at FETOC. There you will have more clarity on how FETOC works. Okay. So after some time, I'll show you that. Chalo sir. With that, we are kind of done with our all the basic three methods: ACM, FETPL, FETOC. Three methods are done. Now formally we have to understand how to do accounting of financial assets, how to do accounting of financial liabilities and compound financial instrument. With that, each chapter is over. But each one section is an ocean in itself. But I'll tell you, sir, the biggest part you already crossed. You just have to understand how to execute it. Newly you are not going to learn anything hereafter. Here onwards, whatever you learned till now, that only a different model flow you will be applying it. But the basic accounting part is set. You just have to be exposed to various kind of concepts and applications for formality's sake. Real learning is already completed. The last two examples, everything is there. The moment you get confused, again walk back and see answers are lying in front of you. Okay, come here, sir. Let's start with the first concept of India's 109. That is accounting for investment in equity shares. Now, if you purchase investment in equity shares, which method to be applied for that? I'll tell you, is standard. India's 109 ka heart la what is there is follow FETPL. I am India's 109 heart. Follow FETPL. What's the meaning of FETPL? Initial recognition at fair value. Subsequent fair valuation also at fair value and gain or loss will go to PRL. One enthusiastic fellow will stand up and say, or not you, will say, sir, if I fair value like this, a gain or loss will coming into PRL, that is impacting my EPS, God promised His share I will not sell in the near future. When anyway will not sell in the near future, what is the point of impacting my PRL section with a unrealized fair value gain and loss and consequently impacting EPS with that? I don't like FVTPL. I will want to follow FVTOC. Argument is valid only. What argument is he doing? I will not hit my PRL because if I hit my PRL, my EPS will dance. I am not going to sell the share in the near future. So why should I transfer it to FVTPL? Point is valid. So what the standard says is, chalo, you have ultimately two choices. At the time of initial recognition, you have a choice either to follow FVTPL or to follow FVTOC. But whatever choice you make, you are stuck with that choice for life. Again, changing back is not allowed. FVTPL or FVTOC, decide once when initial recognition time you decide. But standard ka heart lo what is there? You should follow which method? FVTPL. But this fellow does overaction that I want to follow FVTOC. Standard says okay, follow FVTOC. But now that you are going against my wish, I will penalize you. You know how I will penalize you? Every year you fair value. When you fair value, gain or loss will come. A gain or loss is going where now? OCA reserve. One day, when you sell the investment, your OCA reserve will be now a realized gain. This fellow says, don't reclassify it to PRL. Why not reclassify to PRL? What did you say? I don't want to impact my EPS, and you told or not? You said no. Fine, follow with that. That means in case you select FVTOCA option, a accumulated gain or loss in OCA reserve cannot be recycled to PRL. It has to be directly merged into retained earnings. That's all. That much only, sir. So investment in equity shares, the answer is ideally should follow FVTPL, sir. If it's a long-term investment, you don't want to impact your EPSs every year, then you have the choice of following FVTOC. But mind you, in case you follow FVTOCA, a OCA reserve whatever you are creating, that is not allowed to be reclassified to PRL. Subsequent date when it gets realized, it has to be merged directly into retained earnings. It's like that. That much only. See, why it is not reclassified? I want you to follow FVTPL, but you wanted to follow FVTOCA. I'll allow you that. That means why do you want to follow FVTOCA? You don't want to impact your EPS, no. So don't impact your EPS now also, in future also. So why it is not reclassified? Everything has got a reason in the standard. Fine. This is one thing, sir. Next. Now the problem is, you must realize this. For financial assets, how many methods are there? FVTPL, FVTOCA. Who is the other one? Nobody is even talking about this. It is investment in equity shares. As ACM ka choice is not there. Why standard believes that if you buy shares of another company, one or the other day you will sell it. One or the other day you will sell it. When anyway you will sell it means what? You are interested in fair value. Since you are interested in fair value, if you say that I will carry at cost, I am not stupid to allow you that. Your accounting standard 13, that fellow says long-term investment measure at cost. This fellow says I don't care bro, whether it is long-term or short-term, it has to be measured at fair value. At the best I can give you a choice of FVTPL or FVTOCA. ACM is not permitted. Earlier if you remember scope exclusions, what's the first exclusion? Investment in equity shares of subsidiary, associate, joint venture are not covered under the standard. You know why? They are, sir, subsidiary is my own company, I control that. I may not sell that subsidiary. I may not sell my shares in associate. I may not sell my shares in joint venture. I want to further my business through those companies. I want a cost option there. A cost option will not be given in Ind AS 109. So you scoped out from here, took it to Ind AS 27, their cost option is given for you. That's the reason there is a scope out for that. So move on. It's a very important, interesting one now. Concept number 2. Accounting for financial assets other than equity instruments. Other than equity instruments, any other financial asset ka accounting. Now, all the three things are possible. ACM is also possible. FVTPL is also possible. FVTOCA is also possible. Sir, other than equity investment, what other financial assets can be there? All debenture investment, preference share investment, loan given, staff loan given to subsidiary, security deposit, debtors, all this will fall under the second category. They are not equity investments, they are any other financial assets. Now here onwards the story is very, very interesting. Please pay attention. Now, which method is applicable for you? Which method is applicable for you depends on two tests. First test is called as business model test. Business model test checks the objective of your entity in holding a financial asset. If you have a financial asset, with that financial asset, what are you planning to do? That is called as your business model test. The second test is called as contractual cash flow test or SPPI test. Here we'll check the rights emanating from financial asset. Okay, you purchase a financial asset. What kind of right are you having? So I'll test two things. Number one, why did you hold this investment? What is your intention? I want to know your intention. Okay, I understood your intention. Next, with this financial asset, what kind of rights are you earning? These two things, if I know, I will decide whether I should apply ACM or FETOCA or FETPL. Now, this standard identified that for any entity, only three kind of objectives are possible. With a financial asset, only three objectives are possible for anybody. Number one, hold the financial asset till its maturity. Don't sell it, just simply hold it. For example, a company is issuing bond of 8 years. Today I purchased the bond. If somebody comes and asks me, "Arey sir, why did you buy that company's bond?" I will say, I purchased the bond, I will hold the bond till maturity. I will never sell it. That is one possible answer I can give you. This I am calling it as A, capital A, to hold the financial asset till its maturity. B. No, don't, B. B is, sir, I want to hold till maturity, but if I get a very good price in the market, I don't mind selling it off. What is the difference between A and B now? A is very clear. Sir, I will hold it till maturity. B, I will hold it till maturity, but if I find a better opportunity, I will definitely sell it. That means I am daily looking in the market also. What is the price? What is happening? Is there any better investment? If price has increased or decreased, I am watching that. First case, sir, I will not watch in the market what is happening. Why? My goal is not to sell in the first place. Second fellow has an objective to hold, but investment can be sold also. Third objective, purely to trade. I want to sell. I came here for the purpose of selling it later on. So beyond these three objectives, there is no fourth objective. First objective is to hold. Third objective is to be sold. Between these two dual objective, middle one, B1. Correct, sir? A, B, C. Now come to next test. Who is next test? Contractual cash flow test. What the standard says is, a test is passed when the financial asset provides a right to collect cash flows which represent solely principal payment and interest. So the financial asset should give you a right. A right should be what right? Just to collect cash flows. Which cash flows? Principal cash flow and interest cash flow. Beyond this, one extra right if you have, a test is deemed to be failed. So how many points did we cover till now? A, B, C are objectives. D is a right. A, B, C is your why. D is what right are you having. Why and what I will test. Based on this, I will decide a method for you. Now answer this. A standard says, you will apply ACM if A plus D is satisfied. What is A? My objective is to hold till maturity. What is D? You have a right to receive only cash flows representing the nature of principal and interest. If A and D are satisfied, you will go and apply which method? ACM. Sir, why should I apply ACM? Tell me, sir, are you having intention to sell? When anyway you don't have intention to sell, why should you fair value it? You need not fair value it. Out of the three methods, which method the subsequent fair valuation is not there? ACM. So ACM is given to you. Moreover, your cash flows are in the nature of principal and interest. That means cash flows are fixed cash flows only. Now that cash flows are fixed cash flows, I can find out EIR. Now that I can find out EIR, if I want I can apply ACM. No. So ACM ka all rules are literally fitting for you. A plus D if you are following, you have to go and apply ACM. Next, you will follow FETOCA if B plus D is satisfied. What is B? Objective is to hold, but it can be sold. That means I am having intention to stay till maturity, but I may sell also. That means if I don't know whether I will hold it till maturity or I may sell. Imagine, sir, If I hold it till maturity, okay, will I get fair value gain? No, but I will get interest income. But if I sell in between, then I will get a fair value gain. So I want a method in which there is an accounting for ACM also, there is an accounting for fair value also. Who is that? FETOC. FETOC captures the EIR accounting of ACM. FETOC also captures the fair value accounting of FETPL. I want both. These people who are having dual objective, that fellow will follow FETOC. Okay, sir. Then you will apply FETPL in any other case. So C plus D also is any other case. Sir, then you can write C plus D only, no? No, sir. C plus D definitely FETPL because I want to trade. Now that I want to trade, I am not going to stay till maturity. When I am not going to stay till maturity, all your contractual cash flows I am not going to receive. When anyway cash flow you are not going to receive, how will I compute EIR for you? It's not even possible to apply ACM or FETOC because ACM and FETOC come with EIR effect. EIR means effective interest rate. That means your cash flow should be constant. And I am not going to stay till maturity. How can I apply EIR, sir? I should have some same. No, sir, I can't stay with maturity till with you. I'll sell you definitely. How can I apply EIR? I can't. So I want a method where EIR is not there. Which method is that? FETPL. Next, my intention is to sell. Daily morning I will watch the market. Price increased, price increased. So I am interested in fair value. I am not interested in interest income. So you should apply FETPL. This is classic C plus D wala case. What if your D point failed? D point failed. D point failed ka meaning is the cash flows the financial asset gives me a right other than SPPA. If it is other than SPPA, I'll show you some example for that. D point fails. Once you fail your D point, no sir, you can't apply ACM. You can't apply FETOCI. You don't have any choice other than to apply FETPL. Sir, show me how D fails. Watch this. You tell me whether SPPA test is passed or not in this example what I am telling you. There is a bond, sir. A bond ka maturity is 3 years. Here I will get coupon of 100. Here also I will get coupon of 100. Here I will get coupon of 100 plus I will get maturity value of 1000. Tell me, what I am earning? I am earning fixed cash flows on specified dates. In that interest income is also there. My principal payment is also there. It's a classic case where SPPA test is passed. Okay, now I'll tell you another example. You tell me where SPPA test is passed or not. This is a story of zero coupon bond. Zero. Bond is issued for 750. I purchased this bond. First year, I won't get anything. Second year, I won't get nothing. Third year, I will directly get 1000 rupees. SPPA test passed or failed. SPPA test passed or failed. Passed. How passed? Bond is issued at discount but redeemable at par. Sir, my first year interest, second year interest, third year interest, I am not receiving every year, but ultimately I am receiving or not indirectly? Yes. If you want to take your calculator, write 750 plus 10% plus 10% plus 10% and see. 750 plus 10%. On that again plus 10%. On that again plus 10%. You will almost get 1000. I planned this instrument in such a way that the investor will get a compounded return of how much? 10% interest. He will not receive cash flow every year, but ultimately he will get the cash flow along with interest on interest also. This also is a case of SPPA passed. Now last example, with this you will understand D point more clearly. 1, 2, 3. I purchased a bond, sir. A bond will pay me 100 here, 100 here, 100 here. Face value is 1000. That fellow won't give me 1000. He will give me 10 shares. 10 equity shares of X Limited. SPPA test passed or failed. I invested today 1000, sir. First year 100, second year 100, third year 100. Third year reading 1000 also should come, no? It won't come. 1000 place they are giving me what? 10 shares. You tell me, sir, after 3 years, 10 shares ka value will be 1000. we don't know how much it will be, correct? It can be 2500 also, it can be 800 also, I do not know, but definitely it can't be 1000 unless by pure chance. Okay, now this, is it passing SPPA test or not? Why no? Interest I am getting, but will I get back my principal for sure? No. You invested how much principal? 1000. Is there any guarantee that you will get 1000? You may get more than 1000 also. You may get less than 1000 also. That means a bond is giving you a right to claim cash flows other than principal. You will get cash flow based on what? Equity shares ka worth. Equity shares, if you sell, equity shares ka market value cash flow you will get. That need not be matching with your principal. Your SPPA is gone for a toss. SPPA test failed. The D point A failed. When D point A failed, no sir, I don't care with your intention. When D point fails, you can't apply ACM, you can't apply FETOCA. You have to settle with FETPL. Why sir, I want to apply ACM? No sir, I want to hold till maturity. Okay, apply ACM. What's the first principle? Initial recognition at fair value adjusted to transaction cost. That you will do it after that. On every year, what will you do? Interest income should be measured based on work out EAR and show me. Even if you want to apply also, you can't apply. They are not rules. They are your inability. How will I work out EAR, sir? If I have to work out EAR, my cash flow should be fixed. No, sir. It 10 shares ka market value after 5 years or 3 years. How will I know today? If cash flows are not fixed, how can I work out IRR? I can't work out. It's not like the standard is prohibiting you. You can't do. You can't do. Same reason FETOCA also you cannot do. Because FETOCA also EAR is there. That's why ACM is not practicable for you. FETOCA is not practicable for you. You don't have any choice other than to follow FETPL. Are you getting it, sir? Why these rules are like that? So, once again, sir, to repeat it, A plus D, if you satisfy, you will apply ACM. B plus D, if you pass, you will apply FETOCA. Any other case, you will follow FETPL. If B plus D was a case where you are following FETOCA, tell me, sir, FETOCA principles. Initial recognition should be fair value adjusted with the transaction cost. Interest income should be measured under EIR as if you are following ACM. On every balance sheet date, compulsorily you have to fair value. Gain or loss will go to OCI reserve. Correct? Up to here you remember? Now, when we learnt investment in equity shares, the previous concept, what did we say? I accumulated gain or loss in OCI reserve. Recycling permitted or not permitted? Not permitted. Here it is permitted. Here it is permitted. If you follow B plus D, okay, B plus D you satisfied, and FETOCA is applicable on you. OCA reserve, whatever is there, one day, if it gets realized, the standard says, happily it can be recycled to PRL on disposal. So just now only you told it cannot be recycled. Arey sir, the investment for equity. This is which concept? Other than equity. Okay, I'll tell you another blunt rule, remember this. Entire standard law, sir, recycling is not permitted only in one case, which we just now covered. So, investment in equity shares measured at FETOCA, OCA reclassification is not permitted. Rest all cases, each chapter reclassification is allowed. That's all. One more will come. Okay, one more will come relating to financial assets. Financial assets point of view, only two, sir. One is equity, one is other than equity. Equity not permitted, other than equity permitted. Sir, why is it permitted here, sir? There is a logic, sir. What is your objective? Dual objective. I want to hold. I want to sell. I am seeing both of them. I made a deal with her like, we'll travel, we'll see what will happen. So, if something happens, there is no surprise. I am having very clear thought from the very beginning. If it works, it works. It doesn't work, doesn't work. So, it is that. My sir, objective means it's not your stupid intention. It's a written, documented policy of the company. So everything can be verified in real life. Okay. So if I suddenly sell the investment, it's not like I came out of my objective. No, I always had the intention of selling it. Of course, I was also having the intention of holding it. So if you hold also, it's okay. If you sell also, it is okay. That's why even you ultimately you sell it, the standard will not prohibit you to recycle. They'll happily allow you to recycle. Here, this is very, very serious case, sir. You following FETOCA for investment in equity shares, standard takes it very, very seriously. I'm giving you a choice. exercise that, there is a consequence for that. What is the consequence? A OCA result will not allow you to take it to PRL in no case. And you select FETOCA, again you can't come back to FETPL. That is irrevocable option, only one time choice. So these are the stories in that. Okay, concept number 3, or not yet, sir. Listen. Now we'll come, this concept number 3 will come back while doing case number 4. Come here. Now for financial assets we have certain special cases. Now broadly if I'll show you, special cases, first one staff loan, very important, extremely important. Second one is security deposit, important, once came for 8 marks, demand deposit cheap. This came for 8 marks, loans within the group, the parent giving loan to subsidiary, subsidiary giving loan to parent. These 3 are important cases, sir. Remaining are normal. Okay, now let us start with a proper level question, sir. Okay guys, come here. Sir, is staff loan concept, before I discuss that with you. In this book, sir, I've included one small question, question number 4. Just go through the question once. It's a very interesting question. Your concept base will be slightly at a next level if you understand this question. Easy only, go through it. Page number 27.6 in this book. Otherwise watch on the screen, nothing much. On 1st January 20X1, T Limited bought a rupees 1 lakh 5% bond for 95,000. So 1 lakh face value, 5% coupon rate, you purchased it for 95,000, incurring issue cost of 2,000. So transaction costs are also there. Interest is received in arrears, means end of the year. The bond will be redeemed at a premium of 5960 over the nominal value of 31st December 20X3. That means a bond life is 3 years. At the end of 3rd year, it will be redeemed at premium. The question itself is nicely telling you that your effective interest rate of return is 8%. So summary, sir, face value 1 lakh, coupon rate is 5%, you purchased it for 95,000, transaction cost you incurred 2,000, redemption premium is there 5960, EIR is 8%, life is 3 years. First year ending fair value is 1,10,000, second year ending fair value is 1,04,000. Now explain with calculations how the bond would be accounted for all the years if, first case, T Limited's business model is to hold bonds until the redemption date. What is the meaning of this? Holding till maturity means point number A, objective A is satisfied. Since it is a debenture investment, D is automatically satisfied. A plus D is satisfied. Which method you have to apply? ACM. Now you tell me ACM ka initial rule please. Fair value adjusted with transaction cost. At what rate did you buy? 95,000. How much transaction cost did you pay? 2,000. 95 plus 2, 97,000. So your initial recognition is done at 97,000. What is the EIR given in the question? 8%. So apply 8% on 97,000. You will get 7760. First year coupon, sir. What's your face value? 1 lakh into 5%, 5,000. So 5,000 you collected. This is balancing figure. Since I am following ACM, I should not be rating fair value and all. Whatever balancing figure comes, just shut up and write that. Come to second year. Second year starting point again, opening balance. Again apply 8%, I got 7981. Again receive 5,000, 5,000. Again balancing figure. Third year. Again opening balance, again interest income, again cash amount, whatever you are going to receive, account tallies off. Sir, why account tallied? Surprise, Adi? Account becoming 0 is surprise. Under ACM, no. I identified all the future cash flows, then only I will work out EIR. No, sir, my EIR 8% factors all my future cash inflows. So suddenly account becoming 0 is no surprise for us. Natural. Okay. Now, point number B. Think here. B point important, sir. Please read. T Limited business model is to hold bonds until redemption, but also to sell them if investment with higher returns become available. He is directly telling, I'll stay with you till I find somebody better. Holding till maturity, but can be sold also. Dual objective. B plus D satisfied. Which method? FETOC. Now FETOC initial recognition. Fair value with the transaction cost. I'll still apply EIR. I apply EIR. But closing balance should be at fair value. Now come here. First year 97,000. You apply EIR 7760. Sir, how did you get 7760? 97,000 into 8%. Once do that on your calculator. Simply do, sir. You got really very nice. You received how much? 5,000. Closing balance you have to record fair value. The account will not tally. Gap will come. This I will transfer it to OCI reserve. If I don't fair value, sir, the account ka balance would have been 99,760. But because I fair valued, I wrote closing balance as 1,10,000. So 10,240 rupees is a fair value gain. Do you all understand? Since you are following FET OCI, the gain will go where OCI reserve kit will go. Clear ma? Come to second year ka opening balance. What is second year ka opening balance now? 1,10,000. Come to second year ending. You have to record interest income. You have to record interest income. For recording interest income, you take this 1,10,000. On that, if you apply 8%, you should get 8,800. There only you will burn your finger. Wrong answer. Sir, ACM calculation EIR whatever is there, 8%. Here also same 8% only have to use, no? 8% calculation which all numbers did you factor? Initial outflow, future inflows. Fair values are factored in that. How can you apply 8% on opening balance fair value? The wrong number. Sir, then what should I do? ACM lo whatever number you have, copy from here. E number first year, E number second year. First year when you did FETOCA, you never had a problem because ACM ki FETOCA ki starting point same. But when you come to second year, ACM ka opening balance will be different, FETOCA ka opening balance will be different. So you cannot apply 1,10,000 into 8%. So what you should do? First go to previous ledger account. ACM lo what number is there, identify that. Number you copy paste here. It's not capital, sir, copied. My stupid typist wrote it wrong. Okay, it's all copied from ACM. So, sir, if they ask us FETOCA accounting, should I first do ACM accounting? You can prepare an ACM table. Prepare ACM table, interest strip whatever is there, that you copy paste every year. Are you understanding, sir? Only the interest part of ACM is relevant here. This is a specific case, sir. Earlier we did one question, investment in equity shares measured at FETOCA, correct? At that time, the principle was not applied because that is not an asset where you earn interest income. Here you are earning interest income. So you have to apply EIR, and you have to apply EIR not on the fair value. Had you followed ACM, what interest income would have come to you, that number you have to record here. So you should be very, very careful with this. So anyway, 7981 I copied. Closing balance again fair value. The gap came to loss, again transfer to OCI reserve. Now come to third year. Third year also repeat. Again loss came. This also went to OCI reserve. Okay. Now, is investment in equity share or investment in bond? This one. Investment in bond. OCI reserve is allowed to be recycled or not? Yes. Take your calculator now. First year how much gain did you get? 10,240. Right? 10,240. That much gain is there. But second year you got a loss of 8,981. Remove that loss. 10,240 OCI reserve lo you parked. Again there is a loss of 8,981. Remove 8,981. Third year again loss came. 1,259. Remove that also. How much are you having? 0. How did it become 0? You told we can recycle it. But actually OCI reserve balance is how much? 0. Sir, why is it 0? Why won't it be 0? What is your objective? Hold till maturity, or it can be sold. But ultimately what did you do? You held it till maturity. That means whatever cash flows are going to come, you collected everything. Did you sell? When you never sold, how will you get fair value gain in your face? Whatever fair value reserves you created, everything automatically gets cancelled. OCI reserve will not be there for you. It naturally dies. Why it naturally died is, you held the investment till maturity. Imagine, sir, third year beginning you sold off the investment. Third year beginning you sold off the investment for its fair value of 1,04,000. Now, by the beginning of third year, your OCL some balance is there. You can check. 10,240 first year. Second year 8,981. How much balance is there? 1,259 balance is there. That will be recycled to your PRL. So, fair value gain if you want to enjoy, compulsorily you have to sell it. If you hold it till maturity, how will you get fair value gain? You will get only contracted cash flows. Contracted cash flows, then income is only EIR. That anyway you recorded. Fair value gain naturally will die, sir. OCI reserve will get cancelled naturally. But if you sell the investment, then our OCI reserve, some balance will be left over. That you will recycle it to PRR. That you can't observe in this question because I held the investment till the maturity date. Okay, this will give you like one overall view of how to apply ACM, FETPL and FETOCA. Accounting, if it is you are having clarity, sir, is standard and nothing is there. It just you have to see more examples. That's all. Let's go to one's first special case on staff loan. Question number 6 is there. Question number 7 is there. Okay, 6 we will do. 7 also will do. 2 questions will solve. One will see, one we will do. Okay, chalo. Come to question number 6. On 1st April 20X1, Star Limited has advanced a housing loan of rupees 15 lakhs to one of its employees at an interest rate of 6% per annum, which is repayable in 5 equal annual installments along with interest at the each year ending. So 15 lakh loan you have given, 5 installments, so that fellow has to repay. You gave loan at the rate of 6%. And he says, employee is not required to give any specific performance against this benefit. The market rate for similar loan for housing finance by the banks is 10% per annum. What is he trying to say is, market law, people charge 10% for this kind of loan, but you gave it only for 6%. Why? Because he is our employee. You love your employee, so you gave loan to him at a lower interest rate. Okay, sir, continue. The accountant of the company, he will do some silly thing. Has recognized the staff loan in the balance sheet equivalent to amount of housing loan disbursed, 15 lakhs. The interest income for the year is recognized at the contracted rate in the statement of P&L by the company, which is 90,000 rupees. Analyze whether the above accounting treatment made by the accountant is in compliance with relevant Indias. Sir, in all this kind of questions, accountant will definitely mess it up. Okay, you chartered accountant will go and correct it. If not, advise the correct treatment of housing loan, interest and other expenses, blah 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 blah. Okay, fine. Now watch this, sir. What is the loan amount given? 15 lakhs you have advanced. Contractually 15 lakh rupees you have advanced. Number of installments is 5 equal annual installments. That means in your annual installment, each installment will be equal to rupees 3 lakhs per annum. Apart from 3 lakhs, which is the principal portion, you also have to pay interest at the rate of 6%. How much is that rate given? 6% per annum. 6% on which? On outstanding balance. Now, sir, if I plot all these cash flows, year 1, 2, 3, 4, 5. My principal cash flow, first year will be 3 lakhs, second year also will be 3 lakhs, third year will be 3 lakhs, fourth year 3 lakhs, fifth year 3 lakhs. This is the principal. Apart from this, I have to also charge interest at the rate of 6%. Tell me, sir, throughout first year, how much loan was outstanding? 15 lakhs. 15 lakhs into 6%, 90,000. First year ending, that fellow paid off 3 lakhs to us. So how much is outstanding now? 12 lakhs. 12 lakhs into 6%, 72,000. So, since 3 lakhs is paid, 3 lakhs into 6%, 18,000 rupees interest reduction is happening. You understand the pattern? 90 became 72. Now 72 will become how much? 54. 54 will become 38. How much is that? 36. 36. 36 will now become 18. Every year 18,000, 18,000, 18,000. It's coming down. Why is it coming down? As you pay 3 lakhs, 3 lakhs, 3 lakhs. 3 lakhs into 6% also we need not pay in the next year. So interest. So total contractual cash inflows. Add these two. 3 lakh 90,000, 3 lakh 72,000, 3 lakh 54,000, then 3 lakh 36,000, then 3 lakhs 18,000. Guys, these are all the cash inflows that you are going to receive in future from your employee. In this cash inflows, how much interest rate is there? You only computed now what are looking at my face. How much interest rate is there? 6% interest is there, correct? No, sir. If this employee fellow goes to the bank and tell the bank that bank, I will pay you all this money. How much loan will you give me? Will you give me 15 lakhs? So will the bank give 15 lakhs to him? Why? Bank will not give 15 lakhs. Bank will say, Arey, who told you that interest rate is 6%? The interest rate which I will charge is how much? 9%. If this is what you are going to pay me in future, then I won't give you 15 lakhs. I'll give you something less than that. How much is that? How will I know? Simple. What you do is take PV factors at the rate of 9% and discount all these cash flows to today. Market rate is how much? 10. Even better. Okay. 0.9091, 0.8264, 7513, 683.621. No? 6209. Correct. 6209 is fine. PV factors first 5 years. Marry them. Present one. Fatavat, do it. Don't see and tell. Correct answer. No. Total. 13 lakh 54,000. 602. Okay, sir. Others stop doing. It's enough. Why do you do unnecessarily, sir? Watch this. Focus on this. This is called as fair value of the loan. That means, understand, the moral of the story is, for the cash inflows what the employee is going to pay to us, considering the market interest rate, that boy actually deserves loan of only 13,54,602. If I exactly give 13,54,602, then it is like I am earning a return of 10%. But my kind heart made me give how much amount of loan? 15 lakhs. So actual amount given is how much, sir? 15 lakhs. So how much money did you give over and above the fair value? Excess amount 1,45,398. This is towards my, correct, no, sir? So because he is my employee, I did a transaction other than fair value. If he is not my employee, will I give 15 lakhs for this? I will give only 13,54,602. Because you are my employee, I gave loan to you at a lower interest rate. Correct? I did some favor for you. What is the favor amount here? 1,45,398. Now you tell me, sir, from a company point of view, whatever loan we have given to the employee, what is the objective of that loan? To collect or to sell? Will I sell my employee loan to somebody else, sir? No, sir. I will only collect it. So purely the objective is to hold till maturity. So which method is appropriate? ACM. Tell me ACM ka initial rule. Fair value adjusted with the transaction cost. I don't have transaction cost. So answer will be at fair value. If I write my first entry at beginning of year 1, my entry will be this. Staff loan, which is a financial asset, okay? It should be debited only with 13,54,602. To bank, I paid an amount of 15 lakhs. 1,45,398 rupees I have extra given to the employee. Now, you have to check. Normally, sir, in staff loan, one inherent condition will be there. Suppose I give a loan to you, interest-free loan or a concession interest rate loan. Can the employee say, thank you very much, sir. Okay, this is my paper. I am joining some other company. I will keep on paying the loan for the next 5 years. Thank you for bearing. He goes away. Will you accept it? So primary condition is what? Employee has to stay in service till the loan period. The basic implied condition. He need not come and dance in front of me every day. But he should not leave the company also for the next 3 years. Correct? Or 5 years in this case. So, by giving a concession interest rate loan, you are indirectly blocking the employee in your office only for the next 4-5 years. First, making him stay for the next 5 years, you gave him today an extra amount of 1,45,398. There is no love and all. It's all business. So, since it is for future benefits from service, you will debit it to prepaid staff cost. Normal prepaid expense, sir. You don't like that name, change the name. Sir, hereafter what will happen? Hereafter what will happen? This is financial assets, sir. On this you will go and apply ACM. This money I don't know where he will spend. He will spend off employee fellow. This prepaid staff cost will be amortized to P&L account. So expense to PRL on straight line method basis. Divide, sir, 145,398 divided by 5. 29,080. 080. Okay, 080. Every year this much amount keep on transferring. Khatam, game over. Only this much. 080 is wrong answer. 0. Okay, fine, correct answer. Okay, now the accounting will keep on happening, sir. Now you tell me, now that it's a 5-year loan, nobody asked you 5 years accounting in this sum, but still 1, 2, 3, 4, 5. Don't worry, I'm not so innocent to read so many entries. Tell me, sir, ACM ka every year entry, financial asset account debit to interest income. Next, that fellow will pay you money every year. So as you receive the money, you credit your financial asset. A prepaid staff cost account, every year amortize it to P&L account. D point, identify the closing balance of the loan each year. If 4 things you keep on doing, sir, do it like this for a period of 5 years, a staff loan account will become 0. A prepaid staff cost will become 0. Whatever money you gave to that stupid, that fellow will pay you back also. Everything will be neatly closed. Okay. On the first day, you recorded this at what number? 1354,602 into, what is your interest rate? 10%. Market interest rate. Apply 10%. So you will have 1,35,460. Leave chiller. 135,460. How much money will he pay you in the first year? 3,90,000. Collect that. 3,90,000. Prepaid staff cost ka amortization 29,080. First year ka closing balance. Take your calculator, all of you. Initially you recorded at what value? 1354,602. You added 10% to that. 1,35,460. Total receivable. Out of that we collected already how much now? 3,90,000. Money came off already. So still receivable is how much? 11,62. This one, really? Okay, nice. So like that, if you keep on doing, sir, towards the end it will become 0. In this, nothing you can miss. As it is only you have to do. Here most important one is this one. If you don't work out closing balance correctly, next year ka interest is gone. Thereafter, subsequently everything is gone. Okay, one number can change your life. So a closing balance correctly you post. And this kind of presentations don't do in the exam. Nobody likes a smart ass. Okay, so if you try to show off, no sir, they will. Sir, then they give you 12 marks or 14 marks. You try to pull off something like this kind of trick, you lose marks, sir. They expect you to write year on year entries. They don't want to show an Excel sheet of the entries. Labor work. Do. 14 marks kids coming, no. So do. But just E-class this is okay. But normally I also wouldn't have done that. Are you understanding, sir? See, my objective is to make you teach that these entries are common every year. Numbers will change obviously. Okay. Now, do me one small favor. Tell me numbers again. If I want to prepare a ACM table, how many years? 1, 2, 3, 4, 5. Okay. Opening balance 13,54,602. First year ka interest income 1,35,460. This is done at the rate of 10%. My cash inflow received 3,90,000. Closing balance 11,62. Second year also you do 11,62. 1,10,001. 6. Okay. Second year cash inflow, please. 3,72,000. 838,068. Like that it goes on, sir. If you come to the end of 5th year, 100% it will become 0. If 1 rupee, 2 rupee chiller and all is left, adjust in last year ka interest and make it 0 there. It will 100% become 0, sir. There is no doubt in that. Okay, now my point is, I am standing at the end of the first year and I am preparing balance sheet. In the balance sheet, I have a staff loan receivable. This is very clearly asset, that too financial asset. How much amount am I having? 11,62,000. I want you to tell me in this how much is current, how much is non-current. Because we studied schedule 3 for a reason, no sir. So tell me, how much is current, how much is non-current? 3,72,000 is current. I am already standing at the end of first year. My total receivable is how much? 11,62,000 rupees. In this, how much is current? Meaning is what? Current asset definition is what you tell me? Any one out of the 4 criteria. Correct? I can't apply operating cycle. This is not held for trading. This is not cash and cash equivalent. That leaves me only with one choice. That amount which is collectible within the next 12 months. Next, out of this 11,62,000, how much is collectible within the next 1 year? That is current. Remainder is non-current. Tell me, how much is collectible within the next 1 year? Sir, are you blind or what? It's visible there now. How many times should you ask? Arey, E 3,72,000 next year ka interest will be included. Next year ka interest will not be part of this. But in next year ka interest will be part of this. Be careful. So, next year 372,000 I am collecting. But a 372 next year ka interest also will be there. Next year ka interest is how much? 1,10,006. So 3,72,000 I am getting. In this next year interest also will be there in that. Remove that. 1,10,006. In net figure is how much now? 261,994. What is this 261,994? Out of this 11 lakhs, some principal amount is collected in this. Our number is current asset. Remainder is non-current asset. General mistake is the entire number people call it as current asset. That is wrong. Why wrong? Next year ka cash inflow, next year ka interest will be there. The interest became due at the end of second year. Then how can it be there in this first year ka closing balance? It can't be there. So 11 lakhs 110 is not there. But 372 110 is there. I want to know out of this 11 lakhs how much is collected here. So how should I do it? From 372 remove 1,10,006. That is the principal amount which is going to be collected within the next 1 year. Now, can you guess this one now? Total 11,62,000 sir. In the 261,994 is current. Remainder is non-current. How much is remainder number? 8,38,000. Can't you find some shortcut now? Yeah. So instead of working out this, be smart. Next year ka closing balance is non-current asset. This you take it as balancing figure as current asset. Are you getting it, sir? First logic you understood. But you feel convenient with the second one. First one is better for you. Both are equally good. Second one is good. Don't follow second one, stupid people. Sir, second one is convenient, but it will not work always. Watch this. In second year, watch carefully. What is your interest income? 1,10,000. What is your cash flow? In some it is okay, it will work. Imagine, sir, in some other cash flows, the number is only 72,000. What does it mean, you know? Next year ka cash flow does not even recover next year ka interest only. Which means nothing out of this is getting collected in the next 1 year. It is entirely non-current asset. So a shortcut if you follow means it will work everywhere. This shortcut what you are seeing will not work everywhere. In particular sum it's working because next year you are recovering more than your next year ka interest. So some portion of current year outstanding is getting recovered. So next year ka closing balance you can take it as non-current, this you can call it as current. But imagine a scenario where next year ka interest is 110, your cash flow is only 72,000. In that case, your next year ka cash inflow is not even recovering next year ka interest. E principal definitely is not getting recovered. It is totally non-current. Be watchful. Shortcuts don't follow. Some stupid wrote that in his book. Wrong answer. It will not work always. I have that kind of question also where it will not work. So shortcuts sometimes are dangerous. Don't follow. So original technique you keep, they always safe. Sir, any doubt in this? So you just have to remember one small entry. Staff loan, prepaid staff cost to bank. Staff loan you will go and apply ACM. Prepaid staff cost you will go and amortize it using straight line method. Clear? Easy? Okay. Okay, sir. This is one question number 6 on staff loan. Okay, come to question number 7. This is the biggest question that has ever come on staff loan model. When it came for 12 marks. You see what is different in this. Wheel Company Limited has a policy of providing subsidized loans to its employees for the purpose of buying or building houses. Mr. X, who is executive assistant to the CEO of Wheel Company Limited, took a loan from the company on following terms. So our company gave him a loan of 10 lakh rupees principal amount. Interest rate is 4% for the first 4 lakhs and 7% for the next 6 lakhs. The starting date is 1st of January 20X1. Tenure is 5 years. Prepayment is also possible at the option of the employee. So, the principal amount of the loan shall be recovered in 5 equal annual installments. That means 10 lakh rupees divided by 5. So, your each installment would contain 2 lakh rupees principal payment. And he says, and it will be first applied to 7% interest bearing principal. Normally, sir, on your loan you will have one interest rate. This fellow is having dual interest rate. For 4 lakh rupees interest is 4%. For the 6 lakh rupees amount the interest rate is 7%. And now he is telling that as and when the employee pays the installment, the first installment will be used for killing this 7% principal. Once that 7% principal is exhausted, last 2 installments are towards 4% principal. That's what he is trying to communicate there. The interest shall be paid on annual basis. Okay, along with the principal you also have to pay interest. Mr. X must remain in service till the term of the loan ends. That's a condition. The market rate of a comparable loan available to Mr. X is 12% per annum. So the market interest rate. But actually we are giving loan at what rate? Some at 4, some at 7. But definitely not at market interest rate. It is below market rate loan. Now that it is a below market rate loan, is the company giving some benefit to the employee or not? Yes. And for that the employee is supposed to stay in the service for a period of next 5 years. So definitely a gap will go to prepaid staff cost account, just like in the case of previous example. Then the following table shows the contractually expected cash flows from the loan given to Mr. X. If you remember, sir, in the previous sum when we were solving, contracted cash flows we worked out. These numbers question did not give. Question give the data. With that, principals we calculated, interest we calculated, we identified the contractual cash flow, then we discounted and we got the present value, which is the fair value of the loan. But in this sum, loan ka cash flows that fellow only gave 10 lakh rupees outflow. First year, second year, third year, fourth year, fifth year. Coupon, so sorry, principal installment 2 lakhs. Interest income on how much amount? 6 lakhs. 6 lakhs. On 6 lakhs it is 7%, 42,000. On this 4 lakhs it is 4%, 16,000. So first year ka cash flows are given to you. But by the end of first year, you repaid how much principal? 2 lakhs. So for second year, how much is outstanding? 8 lakhs. In that, 4% is 4 lakhs, 7% principal is another 4 lakhs. So like that, 7% 4 lakhs, 28,000, 4% 4 lakhs, 16,000. Like that for all the 5 years he computed the total cash flows. And ultimately principal will become 0 by the end of 5th year. That means basically planned contractual cash flows you should not or you need not work out. Question already gave. If you want to work out, you work out, you will get the same numbers. Then, this is Mr. X, sir. Mr. X prepays rupees 2 lakhs on 31st December 20X2, reducing the outstanding principal as on that date to 4 lakh rupees. This is the only twist. Now, loan ka starting date is 1st January 20x1. First year ending 31st December x1. Second year ending 31st December 20x2. So by the end of second year, he should have paid how many installments? 2 installments. First year one 2 lakhs, second year one 2 lakhs. But stupid what he did, second year ending, he prepaid. Means third year, fourth year, fifth year, another 3 installments are there. In that one installment, he paid off on second year only. It so happened now that by the end of second year only, he already paid 3 installments. So remaining how many installments are there? 2 are there. So originally it is planned as 5 installments over 5 years. But by the end of second year, he already paid 1 installment extra. So 3 installments he paid. The following table shows the actual cash flows from the loan given to Mr. X considering the prepayment event on 31st December 20x2. This is originally planned cash inflows. These are actual cash inflows. Actual cash inflows, how are they different is, first year nothing different, sir. But in second year you observe, you are receiving how much amount? 4 lakhs. So third year you will receive another 2 lakhs, fourth year you will receive another 2 lakhs. But fifth year you will not have any cash inflows to receive. Why? All the installments will be completed by the end of fourth year itself, and fifth year there is nothing more to receive. So effectively he is trying to prove that by the end of fourth year only loan ka drama will get over. Your financial asset must be cancelled by the end of fourth year itself. Though originally it is planned for how many years? 5 years. He is asking record journal entries in the books of Wheel Limited considering the requirements of Ind AS 109. Now, it's quite an important question only. So let's see how to handle this. So first and foremost, you have to always work out the fair value of staff loan. And remember this. The term fair value means market based measurement is called as fair value. Official definition and all is there, that's no use for you. Fair value means market based measurement. If it is a listed equity share, market price is the fair value. Listed bond, market price is the fair value. Sir, are they unlisted? How will I know? If bond is unlisted, go and work out fair value using your bond valuation chapter. In AFM there is a chapter called as bond valuation. How will you work out the value of the bond? Present value of your future cash inflows discounted at YTM rate. That only is your fair value of the bond. You apply that technique. So, loan is nothing but it's a kind of bond only. No, sir. Bond is a security form of loan. Without security, if you issue money, that is called as loan given. Which security we call it as bond or debenture. Okay, so any kind of loan transaction ka fair value is nothing but present value of future cash flows discounted at market rate, market interest rate. Not only in this sum, any sum, loan ka fair value is nothing but present value of future cash flows at market interest rate. Now, in this particular sum, your cash flows originally are planned across how many years? 5 years. And your cash inflows are, see the question and answer, sir. First year ka cash inflow is, this one only, 2,42,000 plus 16,000, 2,58,000. Second year, how much is second year? 2,28,000 plus 16, 2,44,000, 2,44,000. Next, how much? 2,30,000, 30,000. Next, 2,16,000 and 2,08,000. So these are your contractual cash inflows. Market interest rate is given as how much, ma'am? Here they give you market interest rate is 12%. If you want to know the fair value of anything, discount all the loan cash flows using what rate? Market interest rate. Market interest rate is given as 12%. See, if every year cash flows are same, I could have applied annuity factor. That is not same, no. So I am doing individual PV factors. So this will be 0.8929, 0.7972, 0.7118, 0.6355, 0.5674. Multiply all this. Final answer we want. Individually don't fill up and waste your time even in the exam. So fair value of staff loan 843,886. Okay. Some rounding of error, it doesn't matter. Okay. So for the amount of cash flows you are going to receive, if you want to earn an interest rate of 12%, you should ideally invest on him only an amount of 843,886, not a rupee more. Since he is your employee, you want to exploit him. What you did, you actually gave him amount given as loan. Official loan amount is how much, sir? 10 lakhs. So what is the excess amount you have given now? 1,56,114. Is the excess amount you have given. For this excess amount what you have paid to the employee, that fellow will work in your office for a period of 5 years. It's a kind of a prepaid salary for using which you will make him stay. Now the accounting he is asking for entire 5 years anyway. So watch this here. So staff loan account debit to bank. Staff loan, you must understand the logic like this. Staff loan is a financial asset on which accounting is applicable? ACM. Since ACM is applicable, initial recognition should be done at fair value adjusted with transaction cost. I do not have any transaction cost. So fair value. Fair value number is how much? 1,56,000. Sorry. 8,43,886. But I am giving an amount of 10 lakhs. The extra amount, whatever I am giving, this we will debit it to prepaid staff cost account. And this prepaid staff cost account, on this you have to apply SLM. Divide by 5 and tell me the number. 31,223. Okay, some number like that. 223 per annum over a period of how many years? 5 years. This is first day accounting, sir. Now, at the end of each year, like that, for how many years I have to do accounting? For 5 years I have to do. But as I go into the years, I understood that fellow made a prepayment, and as a result, 5-year loan eventually came down to only 4-year loan. So overall I have to do accounting for how many years now? Only for 4 years. Okay, now how to do this is year 1, year 2, year 3, year 4. Sir, examiner, don't do columnar accounting and all, you'll pakka lose marks. This is wrong. Okay, you have to do one by one only. Let me start. So first and foremost, financial asset ACM. So staff loan account debit to interest income. In my first entry. Second entry, contractual cash flow received. Bank account debit to financial asset. Bank to staff loan. Third, a staff cost account, prepaid staff cost, whatever is there, that you kill it to your P&L account. Prepaid staff cost. D, I want the closing balance. So for the very first day, 843, 886 we got into, what is the interest rate you have taken? 12%. Please apply the 12% on this. 101, 266, 101, 266. First year ka cash inflow. First year everything went as planned. He pays exactly 2,58,000. The amortization number 156,114 divided by 5 came to how much? 31,223. So 31,223, 31,223. Closing balance of first year. You start with this opening balance, you debited this, you credited this. So closing balance 687,152. Sir, if you are not writing, at least do on your calculator. No, sir, it will just speed in your thought process, nothing else. So you will have 687,152 closing balance of first year. On that you have to compute interest for the second year. Into 12% you do. 687,152 into 12%. 80, 458. 82,458. Second year ending, he is actually making a prepayment. How much prepayment did he make? 2 lakh rupees extra he paid. If you want, you can write 4 lakhs as it is, plus the interest whatever it is there, or you can handle prepayment separately. Anyway, when adjustment will come, I will do prepayment separately. Now what I will do is, originally planned cash flow is how much? 244. You take that first. There is no problem if you add 2 lakhs and write. Nothing will happen, sir. I am writing like this, see how it works. If you don't take, I'll change it. 31,223. This will not, same number is same. Tell me, closing balance. 525, 610. Okay, 610. Okay, fine. 525, 610. This is at the end of second year. Don't immediately jump off to third year and start. Why? Second year a lot of drama happened now. What did he do? He made a prepayment. Now, sir, look at this. At end of year 2, this fellow made a prepayment. Now that he paid you money, you don't have a choice now, sir. You have to debit bank account. How much prepayment happened? 2 lakhs. 2, you will credit to your staff loan account because you collected money. Because of this, the carrying amount of staff loan from 525 610 minus 2 lakhs just now you removed, another you will have 325 610. Now sir, you tell me, this is a planned cash flow or surprise or no? Surprise. Now surprises are not planned, no sir, obviously. So did your cash flow stream disturbed or not? The moment your cash flow stream disturbed, ACM will fail. ACM will fail. ACM ka technique is compounding technique, sir. It only believes that ACM will work as long as your closing balance represents the present value of future cash flows discounted at your EIR rate. If you disturb your future cash flows ka date or the timing of them, gone sir. ACM will fail now. Now in this case, this fellow did one payment extra 1 year before. Earlier he paid off. Because of this, future cash flows also got disturbed. Now, because of the prepayment, ACM is disturbed. ACM will not work, sir. Third year, fourth year, innocently you write entries, account will not be closed. You will still have some balance. That's not balancing figure also. Pakka, it's wrong answer. Now you have to set it right and then do the reverse accounting. Now, sorry, 0, 1, 2, 3, 4, 5. Mind you, sir, you are already standing here. Second year ending. Timeline point of view, it is 0 for you. Okay. What are your revised cash flows? That also question they give. See and tell. Already you have completed 2 years now. What are your remaining cash flows? 2,16,000 and 2,08,000. One will come in third year ending, one will come in the fourth year ending. You are already standing where second year ending you are standing. So you will receive 2,16,000 here, 2,08,000 here and nil here. Correct? And desired carrying amount of staff loan. If you have to apply ACM, then the carrying amount here should be what? Should be the present value of these two cash flows. Correct? Now you tell me, sir, 2,16,000 is how far from where I am standing? 1 year. So 2,16,000 into 0.8929. 0.8929 is 1 year ka PV factor. Don't apply third year ka PV factor. Don't be so naive. You are already standing at the end of second year. Cash flow is coming at the end of third year. How far is it? 1 year. If you multiply with third year PV factor, you are saying that it's 3 years far. That's wrong, no sir. You are already standing at the end of second year. Similarly, 2,08,000 is standing how many far? 2 years far. So 0.7972 second year PV factor. So you multiply. So tell me the final answer. 358,554. I want 3,58,554 in my staff loan account. What do I have? I have 325,610. Your ACM will work if and only if you have this number. But I have this number. What you have to do? Update. Staff loan account, increase it. So, what is the entry I should write now is staff loan account debit. Tell me the gap, sir. 358,554 I have. Sir, I want minus 325,610 I have. Tell me the gap. 33,074 64. Oh, 6 only here. Check once correctly. Which one 684? Oh, this number wrong. Why so wrong? Sad. Anyway, 358, 680, 680, 684. Okay. If you say so, 358, 684. 358, 684 minus 325, 610. How much now? 33,074. You update the staff loan. Now you tell me, sir, staff loan is a financial asset or financial liability? Financial. When asset value is increasing, that is good or bad for you? I mean, gain or loss, that's a gain. So ideally this gain should go to P&L account. But what your study material suggests is, you already have a open account called as prepaid staff cost account, correct? Now, a prepaid staff cost account, originally it was having a balance of 156,114. Out of this, first year you removed 31,223. The second year also you removed 31,223. You will still have some balance. Some balance is there, no? He says that a staff loan account, you increase it, instead of booking it as a gain, reduce your prepaid staff cost account. Logic I will tell you, but first do it. So prepaid staff cost account you nullify to the extent of 33,000. Now after you writing this entry, what is the revised prepaid staff cost now? 60,594. This will be amortized over remaining how many years? 2 years. At the rate of divided by 2, 30,297 per annum. Now coming to the logic of why you have to credit to your prepaid staff cost account, understand this. Suppose sir, I have two employees, this sir and this madam. To both of them, I gave 10 lakh rupees loan at 2% interest rate. Market interest rate is 10%. Market interest rate is 10%. I gave loan to her at 2%. I gave loan to sir also at 2%. Correct? Now, how much benefit am I passing on to each one of them? 10% market rate, but I am charging interest of only 2%. How much benefit? 8% benefit. Now I am telling you fact. The loan given to her is for 3 years. The loan given to sir for 10 years. Both the loan amount same, interest same, market interest rate same, but the tenor of the loan is different. She enjoys a concessional interest rate loan only for 3 years. He enjoys it for 10 years. Who is getting more benefit? Sir is getting more benefit because he is enjoying concessional interest rate loan for a period of 10 years, whereas she is getting benefit only for 3 years. Correct? Like that, sir, originally when we planned the loan, a loan is supposed to give concessional interest rate benefit to the employee for a period of 5 years. But because of a prepayment, a 5-year loan became 4-year loan. I originally thought that our company expenditure is 1,56,114 because of this concessional interest rate loan of 5 years. But because the fellow made a prepayment, actually this much benefit will not be there to him. So you have to nullify this benefit because a 5-year loan is now becoming 4-year loan. 4-year loan benefit is there, but it will be lesser than a 5-year loan. So to this extent, staff loan balance will increase. Prepaid staff cost account has to be nullified. That's the reason, that's correct treatment. You understanding though? Now, after you write this entry, what is the revised balance of staff loan? It will come down to your desired amount of 358,684. E 358,684, is it representing present value of future cash flows or not? It is. And shamelessly ACM will again work. What is there? Happily write the entries and close the account. No surprise. Come here. 358,684 into 12%. Tell me the numbers. Fast. Well, calculator should break. Do it fast. 40, 042. That only is that. Okay. Staff loan, how much will he pay me? 2,16,000 he will pay. Next year he will pay 2,08,000. This amount came to 30,297 now. Correct. 30,297. Okay. Now year ka balance, sir. Third year opening balance you started with 358,684. To that you have minus 2,16,000 and you added 43,042. Tell me closing balance. 185,726. Now come to the last year. Fourth year is your last year, sir. Now actually 185,726 into 12% should give you correct answer, but approximation chance will be there. We will not take risk. My point is simple, sir. E 185,726 plus some interest should be exactly matching with 2,08,000 and the account should become 0. So what you do, directly take the difference. 208,000 minus 185,726. How much is that? 14,000 plus 8,000. How much? 20? 22,274. If you directly apply 12% also, you will almost get the same number. Because E calculation all we did. We took 4 decimal PV factor and did. So our answer almost will match off also. If you directly do 185,726 into 12%, tell me how much are you getting? 22,208. 287. See, here just a 10 rupees difference is there. That's because I used only 4 decimals there. If you take 1 or 2 more decimals, the gap even further narrows down. But still, it will not 100% match. That's the reason you take this as a balancing. That's all it becomes. Sir, this is a 12 mark stuff, sir. In this, you tell me what is there to not understand. ACM ground rules if you are strong. If you know that ACM will work only if the closing balance represents present value of future cash flows, and whenever cash flow is disturbed, you have to remeasure the staff loan account or financial asset account. Again, that's all. There's nothing great in this. Okay, sir, how much ever they try, beyond this they cannot go, sir. They'll play only around in or around this area. ACM, if you are very confident, these sums are very simple for you. Okay, so we have finished up the concept of staff loan. Next case, look at this. Sir, I am taking a plant and machinery on lease. So this is a lease transaction. Leases accounting is covered in a separate standard called as Ind AS 116. That anyway we will discuss later on. Now, in this lease transaction, I have to pay him some lease rent here, some lease rent here, some lease rent here. Apart from that, the lessor insists that today I pay him some security deposit of 1 lakh rupees. Because his asset is there with me, so safe side, he wants me to deposit an amount of 1 lakh rupees. When will he give me back this 1 lakh rupees? After 3 years, when I surrender the asset back to him, then he 1 lakh rupees, he will release it back to me. So, I invest here, he 1 lakh will come back here. Security deposit recovered. Tell me one thing, will the lessor pay you 1 lakh and also interest also? No. A 1 lakh a doubt. The interest also and all, where will he pay, sir? So in the place where I come from, usually this kind of deposits they won't pay. If I give advance of 6 months, take a building on rent, I stay there for 3-4 years. At the time of vacation, if I ask that fellow that deposit, he won't pay me. Under the established norm. Okay, so means, so how we do is, we identify new tenant. We'll first lure him. You want this property or not? He says yes. First pay me 6 months advance. We'll take from him, and then we will introduce this fellow to the owner and we'll get out. So that's the norm there. Nobody pays that. Interest and all, don't even imagine it. Okay. Now my question is simple, sir. You stand here. Today you pay deposit. The money will as it is come back to you after 3 years. Ask yourself, do you have a contractual right to receive cash flow? Do you have a contractual right to receive cash or not? Yes. So a security deposit is definitely a financial asset. And this kind of security deposits, I can't sell it. Since I can't sell it, FET OCI, FET PL, they are ruled out for me. I have only one method to apply. Which one? ACM. And ACM initial recognition should be done at fair value. That's all. Along with the transaction cost. Here what? No transaction cost is there, so fair value only. So my entry will be security deposit account data to bank. I am paying an amount of 1 lakh. This 1 lakh, even though I pay today, when will I get it back? After 3 years. After 3 years, if somebody is promising to give you 1 lakh, the worth of that 1 lakh today is 1 lakh, or less than that? Less than that. So how much is that depends on the market interest rate. Now, imagining 10% per annum as interest rate, so fair value will be 1 lakh into third year ka PV factor, which is 0.75131. 75,131 is present value. That means a gap whatever is there, 75,131 and 1 lakh gap. How much is it? 24,880, 869. Like how you wrote prepaid staff cost there, this is also one extra cost you are incurring in the course of a lease transaction. Now, towards this lease transaction, already you are paying how much lease? This one and this one. And that fellow won't give this asset on lease to you unless you make this deposit also. But by making this deposit, am I not indirectly losing an amount of 24,869? So overall picture, if I should summarize, your lease cost you 3 lease rents, and first day only you have to pay an amount of 24,869. So originally, sir, when the standard rolled out, they called this as prepaid lease rent or simply prepaid rent. Now you tell me, what did you do with your prepaid staff cost? every year you amortize it to P&L account on straight line basis. Like that only, prepaid rent also will be amortized to P&L account on a straight line basis. This is the original principle. Later on what happened, leases standard got revised. You now have which standard? Ind AS 116. According to Ind AS 116, there is nothing called as concept of operating lease or finance lease from a lessee's point of view. Lessee will always record only one entry called as ROU asset account debit to lease liability. So gone are the days where rent will come to your P&L account as an expenditure. Correct? So what this fellow did is he modified the answer, and instead of prepaid rent, they will ask you to deposit this to debit this to ROU asset. When you debit this to ROU asset, what will happen? Already ROU asset some number will come because of this entry, and now you are again debiting ROU asset. So ROU asset ka balance will increase. What will happen to ROU asset? ROU asset will be depreciated to P&L account over a period of lease. Lease period is 3 years. So every year I will record depreciation account debit to ROU asset. Of course, depreciation is a charge to your PRR. So instead of calling it as prepaid lease rent and debiting it to PRL over a period of 3 years, we are calling it as ROU asset, right of use asset, and we are depreciating it to PRL over a period of 3 years. Accounting impact is same, name changed. Prepaid lease rent, adi asset, ROU asset also asset, but prepaid rent account place, so now you have to use ROU asset. That's the difference. So this one and the previous one was our staff loan. Whenever sir fair value actual amount given transaction value gap comes, a gap accounting you observe. Previously we accounted it as prepaid staff cost. Now we are accounting it as what? ROU asset. There is one more case that also I will tell you. Then overall I will give you a summary of this. Sir, this question is quite important, sir. This as it is came for 8 marks. They changed the number. 8 marks question, sir. They asked you journal entries in 0 today and journal entries on the last day. Now you tell me, after how will you account this? I am not asking about ROU asset. ROU asset I already told you. You tell me security deposit accounting. Hereafter what will happen? ACM will apply. ACM accounting you tell me. Every year, sir, what accounting will you do tell? You will record, see, what is every year accounting in ACM? Financial asset account debit to interest income. That's the first entry. So that means you will record security deposit account debit to interest income. How many years? 3 years. First year, second year, third year. Let's start. 75,131 into 10%. That's 7513. Okay. First year is over. First year ka first entry is over. Tell me, ma'am, will I receive any cash flow? Is it loan transaction where every year I'll get some cash flow and all? No. That means you will not have this entry each year. So first year you will not have this. So closing balance 75,131 plus 7513. How much is that? 82,644. The closing balance, sir. Second year 82,644 into 10%. So that is 8264. Again you will not receive any cash flow. Closing balance 90,908. This year 90,908. Let's make it as 9092. And finally you will receive an amount of 1 lakh. Once you receive this, the amount should become 0. Normal ACM accounting, you see whatever entries we learnt earlier are the maximum entries. Sometimes cash flow not there, I will not write entry. But it is common, sir. Entry will be there. Financial asset account debit to interest income. That is common. Pakka it will be there. Cash flow, if it comes, write. No, doesn't come, don't write. But ultimately it will become 0. Because one day cash flow will come. Like that life goes on. The ACM story. This literally came for 8 marks. Okay, next. Tell me, sir. X Limited gave loan to Y Limited of 1 lakh rupees. And this loan is repayable. That's not subsidiary and all. Repayable on demand. Whenever X Limited asks, Y has to pay. Now, this kind of loans ki how much interest will you expect? Good. You will not expect any interest. Simple example. If you open a current account, you put 10 lakh rupees in it. Will the bank give you interest? No. Why they won't pay you interest? whenever you want, you spotly you can withdraw that money. That kind of demand deposits, ideally you should not get any interest. Since you don't have any interest rate, that means e kind of transactions lesser, the fair interest rate that you should expect is 0%. As an interest rate is 0%, which means what? Fair value will be equal to your transaction value. So then what is the entry you will record? What entry will you write? You will simply go and write loan receivable account debit to bank. How much did you give? 1 lakh. What is the fair value of this transaction? 1 lakh. Sir, you told fair value is present value. No sir. Array sir, present value only. Do with what rate? 0%. How many years you want to assume? So many years. Discount with what rate? 0%. If you discount with 0%, you will get 0. P factor will be 1. Discounting rate is 0% means it's like this, sir. 1 lakh divided by 1 plus 0 whole power n. N is number of years, no sir. So 1 or 2 or 3, whatever you want you place. That is 0. 1 plus PR whole power future value present value formula. Okay, so answer will be C. Now my question is, on this loan receivable you will still apply which method? ACM method. Now suppose first year ending I did not collect the money. Second year ending also I did not collect the money. What all accounting will you do? Tell me the model entries. Model entry is what? Loan receivable account debit to interest income. This is one entry. What is the second entry? Bank account debit to loan receivable. Okay. What is the ideal interest rate you should expect? 0%. 0. If he pays, write this. Doesn't pay, don't write this. This is pakka 0. Second year you collected, he paid, right? ACM does not mean that somehow you should write that entry. No. Those entries what you learn are the maximum. If interest rate is there, your contract rate may be there, may not be there. But in market rate is there, I have to do interest accounting. So market interest rate is 0. Then I will not do any accounting for that. Because my fair value and my transaction value both are same. Whatever interest I taught you initially I teach because I want you to remember them. But that does not mean that forcibly you write that it's somehow in all cases. In case of interest rate, you don't deserve any interest. How can you record income? Can't record. You getting it, sir? So things will be like that. Okay. Now come to one important case in financial asset basic accounting. Now, A Limited gave loan to B Limited. Loan given is 10 lakh rupees. Interest rate is 10%. Market interest rate. Okay, fine. It's a market interest rate at 0% interest. So A gave loan to B at 0% interest. Market interest rate is 10% per annum. Loan period, for convenience, assume 3 years. Now, A and B are belonging to same group. They are parent and subsidiary. Who is parent, who is subsidiary? That's irrelevant for you. But, hurry sir, fine. Imagine whatever you want. So, between parent subsidiary, they gave loan, sir. That is 0% loan. Market interest rate is there. This is not a demand loan. Because the loan period is given. How can it be demand loan? After 3 years, whenever. No, sir. Next 3 years, you can't ask me. It's a time loan only, time based loan, not a demand loan. Now, first and foremost, tell me, what is the fair value of this loan? Fair value of the loan is what? Present value, which is equal to 10 lakhs into third year ka PV factor, 0.75131, 7,51,003, the present value. But actual amount given is what? 10 lakhs. So you definitely gave over and above the fair value. Okay. Now, how to do this accounting in the books of parent? How to do this in the books of subsidiary? Case 1, sir. Parent gave loan to subsidiary. In that case, what accounting you will do in parent books? What accounting you will do in subsidiary books? In parent books, the accounting what you have to do is, for parent it is a loan given, so it's a financial asset. So wait a moment. Loan receivable account debit 7,51,310, which is at fair value. Why you have to apply fair value? Because on this which accounting is applicable? ACM is applicable, so fair value. Leave one line. To bank, you are giving an amount of 10 lakhs. Now leave it here. Come to subsidiary books. For you it is an asset. For subsidiary it is a liability. They raised loan. So bank account debit 10 lakhs. Now you must understand, even financial liabilities like loans and all, they are also accounted at ACM only. Financial liabilities, how many methods are possible? Two. Either ACM or FATPL, which we will discuss later on. FATPL should not be applied whenever you want. Only for 5 cases you will apply FATPL. Rest all cases of financial liability you have to compulsorily apply only ACM. And ACM initial rule will not change, no. So here also this fellow will record it 7,51,310. So here one gap is there, here also one gap is there. How much gap is that? 2,48,690. Tell me, sir, who gave loan to who here? Parent gave loan to subsidiary. In process of giving loan, their feelings also they give. As a result, for the amount what subsidiary pays me, today that fellow deserve only 7,51,000. But because of our relation, I gave 2,48,690 rupees extra over and above what you deserve. This is a kind of free money what I am giving, which I will not indirectly ask you back in future. So this is an investment made by the parent in the equity shares of subsidiary. See, sir, the relation between parent and subsidiary is because of parent's holding of equity in the subsidiary. Tell me, is that amount recoverable? Can you demand that? You cannot demand. Equity share is not a contractual right to receive cash. So 2,48,690 also go and debit it to your investment cost. So the entry will be investment in equity shares of subsidiary. This is not new account. The account is already there with you. The amount also go and add there. That's it. Now, when parent is telling that I invested in your capital, subsidiary should also say the same thing, that you invested in my capital. So this is recorded as a capital contribution from the parent. Only thing is, don't credit it to equity share capital, because you are not issuing any new shares and all. So capital contribution from parent, indirectly nothing but other equity lo throw off this. Because no new shares are issued, now how can you credit share capital? You can't credit share capital, but equity lo you post. A equity ka owner is who? Parent only. That fellow will debit investment in his books. Okay, sir. Now watch the story correctly. When we did staff loan, extra amount given was debited to prepaid staff cost. When we did security deposit and lease transaction, extra amount given was debited to ROU asset. And now you are debiting it to investment in equity shares of subsidiary. Are you understanding, sir? Fair value, transaction value, gaps are coming. A gap accounting is what they will test. Now, sir, this is a very primitive point, that what will happen to this account? What will happen? ACM will happen. Every year cash flow is there, not there, because interest rate is 0%. Every year what entry will you record? Loan receivable to interest, loan receivable to interest, loan receivable to interest. Like that for 3 times you write imposition. A loan receivable account will become 10 lakhs. Collect the money, accounts closed. Are you getting it, sir? Basic ACM ka funda, sir. Nothing great in this. Now, in this case too, subsidiary gave loan to parent. When subsidiary give loans to parent, now parent books how to do accounting, subsidiary books how to do accounting. Now you first frame the skeleton entry, sir. Parent is receiving loan, so for him loan is a financial liability, loan payable. Subsidiary is giving loan, for them it is a financial asset, loan receivable account debit to bank. Both will apply ACM, so both will record initial recognition at fair value only, which is 7,51,310. This fellow gave 10 lakhs, our boy also received an amount of 10 lakhs. Now first come to subsidiaries books. Our parent deserves only 7,51,000, but you paid over and above that. That means, who gave freely money to whom? subsidiary freely gave money to parent. You should not say subsidiary invested in equity shares of parent. That's not correct. No, so subsidiary cannot buy equity in parent after the relationship has been established. So how will I explain this is, a 2,48,690 subsidiary declared a dividend to their parent. When subsidiary declared dividend, they will debit where? Retained earnings directly to other equity. So this will be accounted as a dividend distribution by the subsidiary to parent. So subsidiary will account it by debiting their other equity, and parent dividend is an income. We studied in India 32, no, dividend income should be credited to your PRL. So this fellow will go and credit this to PRL. 248. So when parent gives loan to subsidiary, it is understood as parent invested in the equity of subsidiary. When subsidiary gives benefit to the parent, it is understood as subsidiary declared dividend towards parent. Do you understand? Yeah. So these are the three important cases, sir. Now, suppose what if I tell you everything is same, a loan period is not 3 years but repayable on demand. Repayable on demand. Of course, now that it is repayable on demand, this is 0%. Now that this is 0%, transaction value 10 lakhs, fair value is also 10 lakhs. A gap A does not arise. When gap A does not arise, the accounting is not possible. We will write which entry? Loan to bank. The receiver will write. The receiver will write bank to loan. Amounts will tally off. Gap will not. Gap accounting does not arise. Am I clear here? Now, last case in this. A gave loan to B, and they agreed that B will repay the money to A whenever B is having money. Whenever they have money, at that time they will repay. Is it a demand loan? No. So definitely fair interest rate is not 0%. Okay, sir. So fair value is different, transaction value is different. How will you do accounting? Simple. You have only one choice. When will he have cash flows? When will he pay me? Make a estimate. Once you estimate the numbers, based on the estimate, discount everything to today. Fair value will come. You gave an amount of 10 lakhs. Fair value ki 10 lakhs ki gap is there. Gap ka accounting you have to do. That means accounting will be exactly similar. Only thing is, E particular sum, I told you the money will come back at the end of third year. In that case, you will not know when it will come back. So you have to estimate and still do the same accounting. Sir, what if that estimate fails? Haha, that you already know. If the estimate fails, what will happen? Your ACM will get disturbed. Once ACM gets disturbed, you have to remeasure the loan account again. The story continues. I don't understand, sir. That question is not there till now. Where ACM gets disturbed, only model is there. Why is this flow making a lot of noise here? Okay. Now, I'll show you one small concept, sir. Watch this. Question concept number 3. It's called as a day one difference. Day one difference ka meaning is, sir, whenever you write initial recognition of financial asset, if there is a gap between fair value and transaction value, like our staff loan example, like our loan to subsidiary example, like our security deposit example, gap is there or not? A gap ka accounting how to do. That is officially given in the standard. What that fellow tells is, you wrote financial asset, you wrote bank, E amount some number is there, E amount some other number is there, they both are not matching, gap came. He will ask you only one thing, if fair value, how did you get it? Is it obtained using level 1 input as per Ind AS 113? He will ask one simple question, whatever fair value you have, a fair value, how did you bring that fair value? Is it using level 1 input of Ind AS 113? Sir, Ind AS 113 ka level 1 input means what? Ind AS 113 ka level 1 input means quoted market price. Quoted market price unadjusted. Market la somewhere price should be there. As it is, if you bring, that is called as Ind AS 113 ka level 1 input. Other than that, if you compute fair value in any other method, that is not a level 1 input. Okay. Now what he tries to tell you is, if your fair value is obtained using level 1 input, then our fair value is a very strong fair value. That's the best fair value possible. Now, for example, the number is 1000. You paid 1100, and E 1000 is worked out using level 1 input. He says that there is no compromise with that 1000. 1000 is the best possible number. You only paid extra. How much extra did you pay? 100. This is loss. Go and debit it to your PRL. No sir, I paid 900 only. Gain. Take it to PRL. It will directly go either as a gain or loss to your PRL when it is level 1 input. But if it is not level 1 input, the standard says a gap you can recognize it as a asset if it is appropriate. Now in our example, is staff loan ka fair value is there, no? Who gave you this? Market lo quoted, a stock exchange that will be quoted, sir, for you. You only worked out, no? For working note also you did, no? Who calculated? We calculated. That is not a level 1 input. A number we computed that number. Since that is not a level 1 input, a gap I can recognize it as a asset. Security deposit ka fair value, who computed? We computed. Are they quoted somewhere? No. That's the reason a gap we are accounting at as a asset. ROU asset. Similarly, parent subsidiary transaction, a gap, a fair value 7,51,000 we computed. That is not a level 1 input. Therefore, a gap I can account as a asset. So it's all about a fair value. How did you get it? A fair value, if it is level 1 input, you can't recognize it as an asset. If it is level 2 or level 3, you may recognize it as a asset if appropriate. It is officially one concept, sir. But nobody asked that concept till now. Don't bother, sir. These 3 cases are important. Just handle questions on this. That should be sufficient. Now, whatever concept we have studied, staff loan we have seen. Okay. Now, immediately, this is also staff loan only. Next, if you see question number 9, sir, just run through the question quickly. A Limited has made a security deposit whose details are described below. Make journal entries for the accounting of deposit in the first year and also in the last year. Assume market interest rate for a deposit similar to the, for a similar period is 12% per annum. Date of deposit is this one. Date of finishing date is this one. Gap is 5 years. It's a lease transaction. Market interest rate is 12%. Deposit amount given is 10 lakhs. PV factor also he only gave off. He is asking, do accounting over a period of 5 years. I mean, first year and the last year he wants. What is there, sir? How much amount did you give today? 10 lakhs. How much amount will you get back after 5 years? 10 lakhs only. What is the present value of the 10 lakhs? Multiply with that PV factor. You are giving 10 lakhs, but the worth of the asset is only 5,67,000 some chiller. A gap whatever is there, you will go and call it as ROU asset. The old exam questions are, at the time India's 116 was not in vogue, they called it as prepaid lease rent, but this is nothing but as on today you have to debit it to ROU asset. See, he also see what he did it, year ending, he called it as depreciation to prepaid. That's not actually prepaid lease expense, that is depreciation account debit to our study material. Still this answer only is there, sir, but ideally that is ROU asset, not prepaid lease rent. Prepaid lease rent is old, before 116. That's why I wrote this. This prepaid lease rent would be shown as a ROU asset. Like that last year accounting, sir. Very simple one. The next question, the parent and subsidiary wala case. Same number, sir. XYZ is a company incorporated in India. It provides a 10 lakh rupees interest-free loan to its wholly owned subsidiary. There are no transaction costs. How the loan should be accounted in the financial statements of XYZ, parent, ABC, and consolidated financial statements of the group. Case 1. Loan is repayable on demand. If loan is repayable on demand, transaction value, fair value both are same. There is no gap. So the giver will write loan to bank. Receiver will write bank to loan. That's all. There is no subsequent accounting for that until on the repayment date. Next. The loan is repayable after 3 years and current market interest rate is 10%. Exactly at 10 lakhs, discount by 10% for 3 years, you will have 7,51,310. At 2,48,690 is your gap. Since parent is giving loan to subsidiary, it should be accounted as if parent is investing in the equity shares of subsidiary, and subsidiary will account as if they are receiving a capital contribution from their parent. Loan is repayable whenever ABC has funds to repay the loan. Here you can't do any accounting. You can simply write a statement saying that estimate on what date cash flows are likely to come. Once you identify the cash flow dates, go and apply B point. However you did B, same model you have to do C case also. Okay. What is the accounting you will do in consolidated financial statements? Consolidated financial statements, so no accounting will be there for this. Why? Sir, I am parent, you are subsidiary. Consolidation prepared from group point of view by treating parent and subsidiary as a single entity. How can I give loan to myself? How can I receive loan from myself? A loan will not come at all. So there won't be any accounting when you talk about consolidated financial statements. Clear, sir? So this is our next case. E question, how they changed it in the exam is, Okay, the change question I did not keep in this book because your only selected questions are there. How they decided this question in the exam once it came is A Limited invested in preference shares of B Limited, redeemable preference shares, but interest rate is 0. Redeemable preference share means what, sir? Money will come back. I gave 10 lakhs, but you will give me 10 lakhs when after 5 years. Interest rate 0%. That is as good as I am giving a loan to you at 0% rate. Instead of calling it as loan, they called it as investment in redeemable preference share. Name change, matter is same only. Instead of calling it as loan receivable, investment in equity account debit to bank, we will call it as investment in preference shares account debit to bank. Gap again have to debit to investment in equity shares of subsidiary. Loan place where you will use the word investment in preference shares. So that's how the question came in the exam. Okay, moving on. Chalo. Next concept is impairment or loss allowance on financial asset. So it's a little fresh concept, listen carefully. Now guys, impairment loss relating to financial asset in a very basic level, you know what it means? It is nothing but provision for bad debts. Provision for bad debts only, this standard calls it as impairment loss on financial assets. Now, financial assets, definition of financial asset is what? Cash. Who's the next one? Investment in equity shares of another entity. What is the third one? Contractual right to receive cash or contractual right to receive any other equity share. First one you take. Cash, bad and doubtful debts possible. Cash is already there with you. What bad debts? Leave it. Next one, investment in equity share. First of all, investment in equity share, is it a receivable for you? That is not a receivable in the first place. So bad debts ka chance are not there. So if at all I have to suffer bad debts, that is possible only in the case of receivables. That means debtors, investment in bonds, investment in redeemable preference shares, debentures, loans given, e kind of things, bad debt is possible. Okay, ma? Now look at this. Financial assets can be accounted depending on their business model, either under FVTPL or under ACM or under FET OC. Three methods are possible depending on your business model test and contractual cash flow test. Now, if any financial asset is accounted under FVTPL, impairment provisions, whatever we are going to discuss, they are not applicable. Sir, why are they not applicable? I'll tell you an example, carefully watch. Reliance Ambani issued bonds. Ambani issued bonds, I also will buy and I bought. After I bought, I understood that that fellow is younger Ambani. Not the fat fellow, the other one. That fellow's company duped. Okay, he cheated quite a number of people. So a company failed, sir. A company failed means existing loans they are defaulting. My debenture ka due date is after 4 years. My case don't even ask. Today's loans only, that fellow is unable to pay. My debenture ka maturity date is after 4 years. Yesterday only I bought. Now today it came to news that that fellow can't repay. Okay. Now what will all the debenture holders do? They'll try to sell. Who will buy? Who will buy? People will not be there to buy. What will happen? Start becoming desperate. I yesterday purchased for 1,000. First I asked 900, no takers. 800, nobody. Ultimately 300, 350 it is trading in the market. Bond price has significantly come down. Why did it come down? Risk of that company has increased. When risk has increased, repayment capability will decrease. Automatically market price fair value will fall down. Imagine for this investment I am following FVTPL. If I am following FVTPL, on the balance sheet date what will I do? I will measure it fair value. But fair value has already come down. A gap fair value loss by default includes the impairment loss also. Provision for bad debt is already factored in that. And a loss went where? PRL. That means you booked the impairment loss with the name of fair value loss. And not only that, you also recognize it that where? PRL. Bad debts loss, where will it go? PRL only. So why should I apply this principle? When you do FVTPL, automatically bad debt loss is captured, and it is captured where? PRL. E concept is not applicable. Don't do this. Then naturally FVTPL inbuilt impairment provision is there in that. When you are following ACM, did you ever fair value it? I trusted this Ambani. I told objective A, hold it till maturity. That much period he himself will not be there in that company. You are saying hold it till maturity another 4 years. You started applying ACM. Did you ever look into the market? Did you ever fair value it? No. Today you came to know that the fellow will not pay you full amount. Now there is a loss now which you have to book. Therefore, impairment provisions, whatever we are discussing, is applicable on this. Now you will tell me whether on this applicable or not applicable. Financial asset is measured at FVT OCA. Like how FVTPL I applied, here also I will do a fair valuation. Now when I do fair valuation, fair value loss will come. In that fair value loss, bad debt ka loss is also included. That means, did I account for bad debts indirectly or not? Yes. And investment is already appearing at correct value only in the balance sheet. So impairment provision should be applied or should not be applied? Should not be applied. Why? Investment is already appearing at fair value. When something is already appearing at fair value, what problem do you have now? You should not apply any impairment provisions. But wait. Did you book impairment loss? Yes. Where did you book? OC. Impairment loss should be booked only in PRL, not in OCA. So what the standard says is apply all the impairment principles. Identify the impairment loss. A loss from OCA you remove, put it in PRL. Don't touch the asset. So impairment provisions are applicable here also. Not that I will disturb the asset. I will not touch the financial asset. I will work out the impairment loss. A loss already naturally booked in OCA reserve. I will remove it there, post it in PRL. I will not touch the asset. Asset is already appearing at what value? Fair value. Asal FVTPL case la, asset is not only appearing at fair value, loss also went to, don't touch it. Don't apply this concept at all. ACM, you never fair valued it. Now there is a loss, book it. You understand, sir? Impairment provisions are applicable only for these two cases. First case not applicable. Clear? Now. Sir, how will you measure impairment loss? How you will measure impairment loss? There are multiple methods, right from provisions matrix. Provision matrix means, if an amount is outstanding for 30 days, I will keep 1% provision. Outstanding for more than 30 days, up to 60 days, I will keep 5% provision. Some fellow is very smart. Last 100 days he did not pay. 10% provision. Depending on aging analysis, I will create a provision matrix. Based on that, I keep on creating provision. I can do like that. Based on my past experience. Or, I can do my past experience analysis saying that out of my total data, 20% money will not come. 80% money will come with 70% accuracy, remaining doubtful. Based on past experience, you can make an estimate. But our standard suggests one exclusive method called as expected credit loss method. This is also called as ECL approach. Very unfortunately, on this your study material has spoken at length, questions are not there. But in RTP one question came, sir. Later on in another example, the distant touch the one more question. There 2 questions are there. IFRS la 4 questions are there on this, which are highly relevant for your examination. So if at all it comes, unless you know this concept already, you can't hit it. And it is not difficult. Just watch, go on watching, you will understand. Now sir, I gave a loan to somebody. That fellow owes me these cash flows. 1, 2, 3, 4 cash flows. Here I am going to receive 100, 100, 100, 100 and 1000. In my balance sheet, loan receivable is appearing at 1000. Imagine coupon rate is equal to EIR is equal to 10%. Now, how to do expected credit loss method on this is 3-step approach. Step number 1, how you should think is, if at all this fellow makes a default, which cash flows will not come to you? If some bad happens in that company, which cash flows are not likely to be received? So your step number 1 is cash flows not expected to be received. First you go and identify that. Sir, somebody will expect cash flow expected to be received. I am reverse. We are expecting cash flows which will not come if a default occurs. Estimate that. Let us say E100 will not come, E100 will not come, E1000 40% also will not come if some bad happens. Step number 2. Compute present value of the loss. Discounted discounted at your original EAR. Now, tell me, sir, your loss will start in which year? Third year cash flow 100 will not come. Fourth year cash flow 100 will not come. Fourth year cash flow 400 also will not come. These are your cash flows not expected to be received. Discount it to today. What is your EAR given to you? 10%. 10% third year PV factor 0.75131. 0.75131. This is 0.683. 0.683. Work out PV of loss. Tell me, sir, multiply this and tell me the answer fast. 100 into 70, 75, sir, 500 into 68, 35, 35, 75. How much? 420, yeah? 425, 420? 417 I am making. 417 is PV of loss. This is also called as loss given default. What is the meaning of this is, if at all a default occurs, you are facing a loss of 417 rupees in present value terms. That's the meaning of this. Finally, last step, over. You have to calculate the ultimate loss, sir. Ultimate loss means that is called as expected credit loss. This is a provision what you have to create, is equal to PV of loss, that is your loss given default, into multiply with probability of default. How much loss are we looking at? In this example, 417. Probability of default means, sir, loss, when will it happen? If that fellow makes a default, then it will happen. If he doesn't make a default, a loss I need not suffer. Now, what is the chance of him making a default? That you have to estimate. Let us say the chance of him making a default is 10%. So, multiply with 10%. So, 417 into 10%. Sir, what about 90%? There is a 90% chance he will not make a default. What is there? So, expected value, sir. Portfolio management, you did know multiple possibilities, married with respective probabilities. As anyway 0, so nobody writes that. I will also not write. So, answer is how much? 41.70. This is the amount of provision what you have to create. This is broadly the picture of it. One step ahead is there. Carefully watch. Expected credit loss, two type of ECLs are there. One is called as a 12-month ECL. One is called as a lifetime ECL. 12-month ECL means 12 months expected credit loss. Lifetime ECL means lifetime expected credit loss. Sir, what is the difference? Simple, sir. You are saying that the chance of default is how much? 10%. 10%, when will it happen? Means you are already standing here. If you consider a chance of default happening in the next 12 months and multiply that probability, the loss is called as a 12-month ECL. If you watch over the life of the financial asset and identify the probability of default and multiply with that, then a resulting answer is called as a lifetime ECL. Once again, sir, steps slow change will not be there. Step number 1 is what? Identify the cash flows which are not going to get. Step number 2, discount all that cash flows to today using your original EIR. Step 2 is over. Step 3, PV of loss whatever you are having, that you multiply with probability of default. There are two kinds of probability. One is a chance of default happening in the immediate 12 months, or there is a chance of default happening over the life of the financial asset. Depending on which probability you marry, we call it either as a 12-month ECL or we call it as a lifetime ECL. Now, each stage, one common sense question, correctly think and answer. Between these two probabilities, which one will be higher? 12-month probability will be higher, lifetime will be higher. Obviously, because lifetime we consider the chance of a default happening in the next 1 year also and subsequently also. Moreover, farther the period, higher the risk. Farther the period, higher the risk, because I can't foresee much longer. No, sir. I can foresee what is there in the next 1 year, But in the next 5 years, what is there? How can I foresee? I can't see. The longer period I take, risk is more. Now, ultimately it boils down to a simple concept of this less provision. This is a higher provision. This is lower provision. This is a higher provision. That's all. So, ultimately, 3 steps are there, sir. Third step, you have to multiply with probability of default. A probability of default of 2 types. 12-month probability of default, lifetime probability of default. If you multiply with 12-month probability of default, it's called as a 12-month ECL, lesser provision. If you multiply with the lifetime probability of default, it's a higher provision called as a lifetime ECL. Clarity is there? Now, last question. Sir, which one I should apply? Which one I should apply? You tell me, sir. When risk is high, chance of loss is high, you will go with which one? High provision. That means lifetime ECL. When risk is low, then you will go with 12-month ECL. That's all, sir. If you know that, come here. Look at this table. Start with this one, sir. Financial assets whose credit risk has increased significantly on the reporting date compared to the date of acquisition. First day I purchased bond. A bond ka rating was AA bond. 1 year is over. Bond ka credit rating fallen down. It is C category. Why ratings will fall down? Credit rating of a bond has come down. What does it mean? A risk of the company has increased. When risk of the company has increased, you will go with lower provision, higher provision. Obviously higher provision. That's why you have to go and apply lifetime ECL. This is one case. Second case. Any financial asset where the amount is outstanding beyond 30 days from the due date. Your banking companies like NPA 90 days they gave. This stupid gives only 30 days. Once you cross 30 days, still amount did not come, go create a lifetime ECL. Next. Financial assets that are credit impaired at acquisition. What is the meaning of credit impaired at acquisition? I invested in a financial asset, but it's already bad financial asset. Sir, are you mad or what? Why did you buy a bad financial asset? Now tell me, sir, in real life, do you know people who buy only litigant properties? Sir, your hard-earned money, sir. Will you go and buy a property which is under litigation? It will come at a cheaper price. Will you go and buy? Majority of the people don't buy. Why? They don't want to face the legal hassle. But there are some people who are expert in this. They are quite expert at this. They have legal contacts. They know few gundas. Political support is there. This fellow studied law. Now, there is one fellow who married multiple women. Don't tag your friends now, listen here. So, okay, his grandchildren, sir, example, sir, okay, come here. His grandson is selling a property now. Okay, that great man ka grandson. You are the prospective buyer. You like the house. You are already talking. Meanwhile, another fellow comes who is looking like him only. He says, sir, I am also the owner of this. Without my permission, you can't buy. Tell, who are you? Fine, fine, don't worry, I'll pay you. You also. Tomorrow one girl came. She is also looking like these two fellows only. I am also a part owner. Pay me money here also. Then I understood. Okay, after I buy, 10 more people will come. So, I don't want to buy. I walked off. But there are some people in the market who search this kind of properties and buy. They will clean all the litigation, sell at a high price and go away. Like that, financial assets also, litigant financial asset will be there. Suppose a bank is there, ICICI Bank. That fellow gave loan to some fellow. ICICI Bank gave loan to somebody, 100 crores. That fellow is not paying. Now ICICI Bank wants to sell off this loan. I am an educated gunda. I am rowdy sir, with lot of background and all. I wear formal shirt. But inside I have six-pack and all, some weapons and all I carry. Now, this banker comes to me, sir, see he is not paying loan. You collect whatever you want, sir, you pay me 20 crores. I first inquire about that fellow. He is within my range or not. Understood, he has 2 kids. Enough. So, first I paid 20 crores, buy the financial asset from the bank. Asset ka worth is 100 crores. Then I first go and normally ask him. He won't pay. Next day, his kid won't go to home after school. Then what will happen, sir? Tell me, do I need to search him now? No. He will only come. Sample ki, one finger, little bit, little violent. So automatically 100, 200 crores will come now. So, did I buy a financial asset which is already credit impaired? Yes. Now that I am educated and all, I follow India's. I may be rowdy, but I follow India's. So I will have to create a lifetime ECL. Sir, this is a joke, but factoring companies do exist. Factoring name sounds posh. That fellow is rowdy, sir. Okay. So these people do all this stuff. So lifetime ECL. Sir, everywhere lifetime ECL. When will I apply 12-month ECL? Any other case? Any other case. So if you don't find any of these kind of risks and all, then you go and apply a 12-month ECL. Rest all cases you go and apply lifetime ECL. That's how it works. Okay. Now, last part, sir. How to do accounting for this? You tell me, sir. What is the entry for provision for bad debts? Don't give me a heart attack this side, no. Tell. Entry for bad. I'm not asking bad debts to debtor. That's bad debt entry. I asked provision for bad debts. Good. Tell me, sir. Profit and loss account debit to provision for doubtful debts or provision for bad debts. Correct, no? In the balance sheet, you will have debtors. Some number it is appearing. A provision is a credit balance account. Ideally, it should come on the liability side, but it's not a liability. So what you will do, you will reduce it as a reduction from your debtors. Correct, no, sir? And you will present the net amount. Remember the entry. PRL to provision for bad debts. Look at the entry here. PRL to loss allowance. A loss allowance is a name change. A loss allowance is nothing but overaction done for provision for bad debts. PRL Q debit, a loss allowance is a credit item that you show it as a reduction from your receivable. Net presentation lo, you will have net amount of debtors or net amount of loan receivable. That's how it works. This when financial asset is measured at ACM. Ultimately, asset is getting disturbed or not? By writing this entry, asset ka balance is coming down. But when financial asset is measured under OCI, you are not supposed to touch the asset. Why you are not supposed to touch the asset? Since you are following FET OCI, asset is already appearing at fair value. I don't have a problem with fair value. I have a problem with the place of loss booking. So after doing so much of effort, you will get a loss. A loss you will debit it to PRL and credit it to OCI reserve. Don't touch the asset account. Don't create loss allowance here. Am I clear here, sir? Right. Now watch this. In this, suppose, sir, this is your loan receivable. 1 lakh rupees or 1000 rupees. On this provision for bad debts, you kept 30. It came to 970. Next year, on this loan receivable, while applying ACM, I have to write this entry. Loan receivable account debit to interest income. Question is very simple, sir. Will you apply 1000 into 10% or 970 into 10%? So I have to do EIR accounting no, from next year onwards. EIR rate I should apply on the gross amount or on the net amount. Pinky pong. Yes, sir. Gross or net? Why so? Simple guess. Okay. Answer is you have to apply on gross amount. Not on the net amount. You will apply it on net amount only when default is certain. Asset is crossed the stage of provision. A pakka bad debt. Our stage you have to apply it on net. Over, sir. With this concept is over. Now, recognition of interest income. Even if an allowance is created, EIR shall continue to be applied on the gross amount of financial asset without reducing the loss allowance. EIR is also applied on the net amount after allowance only when the financial asset is credit impaired. Credit impaired means a pakka bad debt. You have a certainty that money will not come. Then only you have to touch on the net amount, sir. E model questions are not there officially from your CA resources. Concept is there in the study material. Question is due, sir. It will definitely come. No surprise. Next month also you will be seeing this. Sir, these things are not taught everywhere. You will not even find in most of the books. People keep some concept only when questions are there. No question, concept also they are removing. It's wrong way, sir. You have to learn this. Anyway, let's recap. What is step number 1? Identify the cash flows that will not be received. Step number 2, discount all that cash flows to today using original EIR. Step 3, a PV of loss whatever is there, multiply that with probability of default. A probability of default are two types. Chance of default in the next 12 months, chance of default in the life of the financial asset. If you multiply with 12-month probability, it's called as 12-month ECL. If you multiply with lifetime probability, we call it as lifetime ECL. Till here, okay? Now, when to create 12 months, when to create lifetime? Sir, when credit risk is absolutely low, then only you will go with 12-month ECL. Rest all cases go with lifetime ECL. It's easy way to remember. Okay. Next, accounting treatment of loss allowance. It depends on financial asset accounting. How is it happening? If financial asset is measured at ACM, you have to touch the asset value. So that's why the entry will be PRL account debit to loss allowance. A loss allowance is provision for bad debts basically. That will be presented as a reduction from your financial asset. But if an financial asset is maintained at FET OCI, then asset is already appearing at what? Fair value. If you are going to create a loss allowance, that will be presented as a reduction from the asset. So don't create loss allowance. What should I do? Debit PRL, credit to OCI reserve. There, sir, what if financial asset is measured at FETPL? Impairment provision say will not be applicable there. Asset is appearing at fair value, gains and losses already went to PRL. You don't have any job to apply this concept for FETPL assets. Clear? Next. Interest income should be applied only on gross value unless there is a default is certain. Asset is properly impaired, credit impaired in fact. Except in that cases, you should not apply on net basis. Clear, sir? Now, 2-3 examples, sir, quickly and then you can leave. Watch here. Where is impairment? Where is the reclassification? Reclassification time is there. Okay, come to question number 13, sir. This is our ICA history. Our A Limited has a portfolio of short-term trade receivables of 300 lakhs from a large number of small clients, but debtors basically. The entity expects percentage of default based on time frame. Determine the amount of allowance for expected loss based on given table. Sir, they only gave aging analysis, default rate, amount of debtor. He is asking, tell me the amount of expected loss. What should I do? Sir, total amount is there. Loss percentage also he only gave. Marry them, sir, marry them. Final answer, total it. Came for 4 marks in the exam. It came. 100% it came. People make format for this also and by heart. What can I say, sir? Okay. Sir, applying mind is easy sometimes. Come here, put in the question. Carefully read the important stuff. On 1st January 20x1, N Limited purchased a bond for 1 million, which is measured at amortized cost. Interest of 10% is payable in arrears. Repayment is due on 31st December 20 x3 to complete x1, x2, x3, 3 years life. The effective rate of interest is 10%. Wait there. Coupon rate 10%. EIR also 10%. The bond is purchased at par, redeemable at par. Transaction costs are also not there. Then only EIR and coupon rate will match. Otherwise, they will not match. On 31st December 20x1, first year ending, N Limited received the interest of 1 lakh. It was estimated that the probability of default on the bond within the next 12 months is 0.5%. They gave you a 12-month probability of default. He says if the default occurs within the first 12 months, then N Limited estimated that no further interest will be received and only 50% of the capital will be repaid on 31st December 20x3. And the assets credit risk as on 31st December x1 is low. Credit risk is low. So you have to go with 12-month ECL, lifetime ECL. 12-month ECL. In fact, you don't have a choice, no sir. That fellow gave you only one probability of default. You have to multiply only with that, no. So anyway, you will go with 12-month ECL only. Only thing is you should know how to compute this. Tell me, what is the step number 1? Identifying the cash flows which are not going to receive. Step 2, discount all that cash flows to today using your original EIR. Step 3, multiplying that number with the probability of default. That's all you got to do, nothing else. Now come here. Cash flow not expected. What is he saying? You are already standing here, sir. You are standing here. You are saying that if a default occurs, this will not come, this also will not come, and it 10 lakh rupees principal whatever is there, in that also 50% money will not come. So 1 lakh will not come, another 1 lakh also will not come, 5 lakhs also will not come. So 1 lakh, 1 lakh, 5 lakhs. Discount it to today using your original EIR of 10%. Ultimately number came to 5,86,750. This is the present value of the loss. By mistake, don't create provision with this. E loss, when will you suffer? If a default occurs, you will suffer. If default does not occur, you will not suffer a loss. What is the chance of default now? 0.5%. That means there is a 0.5% chance that you will suffer a loss of 5,86,750. There is a 99.5% chance that your loss is 0. What is your expected loss? Multiply. You will have 2934. So you ultimately have to create a loss only for 2934 rupees only. Now go to the first line of the question. The asset is maintained at amortized cost. Amortized cost method ki. What is the accounting entry? PRL account debit to loss allowance. Now that you created a loss allowance in the balance sheet, it has to be shown as a reduction from the financial asset, and loan will be appearing at 9,97,066. Tell me, sir, here default is certain, in case default is certain, 100% default will happen, no. So next year interest income should be measured on gross value only, not on the net amount. So that also saves it. See, sir, I wrote all these points because if you read this question, no, sir, the entire concept of revision is there in that. Every point is applied in that, for that sake. Okay, last question for today. Promise on you. On 1st February, okay sir, not promise on you, on somebody. Okay, on 1st February 20x6, E Limited makes a 4-year loan of 10,000 rupees to Fern. So E gave loan to F. The coupon rate is 6%, which is same as effective interest rate. Interest is received at the end of the year. Fantastic. On 1st Feb 2000 X9, wait there, it is originally 4-year loan. On 1st Feb 20 X9 means already 3 years is over now. Fern tells E Limited that it is in significant financial difficulties. At this time, the current market interest rate is 8%. E Limited estimates that it will receive no more interest from the Fern. It also estimates that only 6,000 of the capital will be repaid on the redemption date. Meaning, sir, 4-year loan, 3 years over. That fellow, the borrower, he comes and tells me, I won't pay, do whatever you want. Sir, where is that line given? Sir, F told that he is in financial difficulties. You estimate that interest will not come. You estimate that out of 10,000 principal, 6,000 only will be recovered. Indirectly, how much will not come? 4,000 will not come. Question of probability of default is not there. Probability of default is not there means, what's the meaning of that? 100% default will happen. So probability of default is 100%. Okay, the asset is properly credit impaired here. Now, E particular sum, no sir, obviously risk has increased, you have to go with lifetime ECL. But as such, remaining life is also only 1 year. Here 12-month ECL, lifetime ECL, everything will be same here. Sir, probability of default not given, I don't know what to do, my hands are shivering. Sir, if probability of default is not given, it means it is certain. 100% is the probability of default. That's why it did not say. How should this be accounted for? As usual steps. What is step number 1? Identify the cash flows which you won't get. After 1 year, 10,000 into 6%, 600 rupees ideally I should receive. It will not come. Out of 10,000, I will get only 6,000. How much will not come? 4,000. That means 600 will not come. 4,000 also will not come. Overall, 4,600 rupees after 1 year will not come to me. Step number 1. Step number 2, 4,600 discounted to today. With what rate? Original EIR. What is original EIR given? Is it trap? They will put like that only. Don't touch that. Market interested. Who wants, sir? You are not doing fair valuations. No, I want loss. Original EIR. Is it trap? Don't touch this one. 6% discounted. So, take your calculator, sir. 4,600 divided by 1.06. 4,600 divided by 1.06. 4340. Multiply with 1, which is probability of default. So how much loss you have to create? 4340. That's all his answer. Now, balance sheet asset appears at what value? 10,000 original amount. Minus you created provision of 4340. Now asset will appear at 5660. This is as on today. How many more years life is there? 1 year. After 1 year you have to recognize interest income. Now the default is certain. You have to apply your EIR rate on gross amount or net amount. Net amount. What is net amount? Take your calculator. 5660 into 6%. Do how much did you get? 340. Tell me entry for interest income for financial asset under ACM. Financial asset account debit to interest income. Already your financial asset is appearing at what value? 5660 plus 340. 6,000. Exactly he will pay you how much? Account gets closed over. Are you understanding, sir? A step number 2 a loss cut discounting factor. Why you have to maintain EIR is for this reason. If you bring 8%, 9%, some outside number and all, I can't play this. ACM, how can you bring market rate, sir? Market rate, if you bring, that is fair valuation. You don't do fair valuations. I just want to catch the loss. If you correctly use the correct rate, accounts perfectly will be closed towards the end of it. That's the background for this. Clear? Sum is over. Everything is over. Okay. Since I did not find anything else. Okay, fine. We'll continue tomorrow, sir. See you at 8 a.m. 8 sharp.